Hey folks, welcome you all to a new video. This is CA Ganesh Bharadwaj and this is part 3 of CMA Inter paper 8 cost accounting marathon series. Now, let's get started with the revision of cost sheet chapter. Right now, this chapter, cost sheet, right, is the initial chapter that we would have started with in our regular batch. Now, one more very important thing about this chapter is that there is a slight difference in the cost sheet format followed for the purpose of CA Inter and for the purpose of CMA Inter. So both the institutes have some slight modification with respect to the format of cost sheet. So why am I saying this at the beginning itself? Because if you are a student who has prepared for CA Inter, now please do not think that the same format that you followed for CA Inter can also be followed for CMA Inter. I just wanted to make this clarification before we get started. Clear with this, guys, right? So now let's quickly recapitulate this entire format of cost sheet, right? And along with the logical flow of understanding and of cost sheet of the statement of cost, which is basically cost sheet, right? Now, first of all, what do you mean by a cost sheet? It is a statement showing the compilation of all the costs incurred to produce and sell a product, right? Now, unlike your financial accounts where you have this specific format for preparation of balance sheet P&L, your Schedule 3 of Companies Act, right? With respect to costing, for the purpose of cost sheet, there is no specific format prescribed anywhere. Are you clear with this? This is the main reason why in CA Institute, slightly they follow a different format. For CMA Institute, they follow a slightly different format. So there is no uniform format, a structured format that needs to be maintained, just like your Companies Act that has prescribed the standards for the purpose of, that has prescribed the template for the purpose of preparation of your financial statement. So now, guys, let's get started with this. Now, format of cost sheet. So now, how does your format of cost sheet look like? First, you need to calculate the direct material consumed, right? So, which is nothing but opening stock of raw material plus any kind of additions, purchases, or any direct, charges related to purchase of raw material. For example, freight inwards and all. So, all the costs incurred to bring the raw material to the current location that needs to be also added here, minus your closing stock of raw material, right? So, opening stock plus purchase related costs for the purpose of purchasing your raw material minus closing stock. If you net off these three, you will get the direct materials consumed. Then add your direct labor, add your direct expense, you get something called as prime cost. Now to this, add your production overheads, right? You get something called as works or factory cost. To this, add your opening WIP less closing WIP, you get your adjusted works or adjusted factory cost. Now to this, add your AOH, you get your cost of production. To this, add your opening FG less closing FG, you get your COGS, which is basically your cost of goods sold. Then add your selling and distribution overheads, you get your cost of sales. To this, add profit, you get sales. That's about it. That's about it. Now, right? So why is this format? Why should we prepare this cost sheet in a format mentioned here? Now, the logic for this I will explain. Please do not mug up. Mugging up format of cost sheet means that somewhere even the basics of costing is, the basic concepts of costing is lagging, right? So first you need to understand something called as flow of cost, how cost flows, right? This we have already seen in our regular batch. Nevertheless, right, let me quickly walk you through this. You need not mug up. In fact, you should not mug up even a single thing in subjects like costing, management accounting, financial management. These subjects you should not mug up anything because every single thing is conceptual, right? So we have discussed this in length and breadth in our regular lectures. Nevertheless, let me quickly recapitulate, set the context. I will give you a background and I will also show you that flow of cost once again, so that it will be a quick revision for you to remember the format of the cost sheet. Then we will do one numerical problem, a comprehensive numerical problem. With that, we will be completing the revision of this particular chapter. Now, guys, what happens in case in a company, fine, in a company, there will be three locations, in a company, right? What are the three locations in a company? You have a factory, you have a corporate office, right? And you have a sales depot, a sales depot, right? Right? So what happens in a factory? The manufacturing activity happens. What happens in a corporate office? All this administration related work happens. Basically, what your board of directors will meet in this area. This is the place where decision making is being taken. Clear with this. And what is your sales depot? This is the place from where the goods are being sold. Dispatch happens. Are you clear with this? So in a factory, production activity happens, right? In a corporate office, administration activity happens, and in a sales depot, the sales activity happens. Clear with this? Broadly, there will be three locations for any company, right? Now, further zoom in a factory, there will be three locations. In a factory, there will be three locations. What are the three locations in a factory? One is called as stores. By the way, guys, all these things are not there in your institute study material. I'm giving this background so that you will logically understand the reason, the format of cost sheet. By the time we finish this, you will be able to tell the format by yourself, right? Then you have a place called as factory shop. Then you have a place called as warehouse. Now, in stores area, what happens? Raw material storage happens. Okay, raw material storage happens. In the factory shop, what happens? This is the place where the machines are present and the raw material gets converted into FG, or in other words, the actual production activity, the actual production activity happens here in a factory shop. And what happens in a warehouse? In a warehouse, you have storage, storage of the finished product, right? Storage of finished goods. So the finished goods will be stored here. From here only, goods will be sent to the sales depot, and from there the goods will move directly to the customers. Clear with this, guys? Now, basically, in other words, this stores area predominantly deals in raw material. This factory shop area predominantly deals in conversion of raw material into FG, that is your WIP, work in progress. And this warehouse area deals in what? Finished goods. Are you clear with this, guys? Right? Now, if you notice, this cost sheet is nothing but a statement prepared to calculate your overall cost incurred. Are you clear with this? So first what we do is, we keep adding up all the costs that we incur, right? First we arrive at something called as cost of goods sold, right? And further we add all the other selling and distribution expenses and all, and we finally arrive at cost of sales. What is the meaning and all? Let me just quickly walk you through that. Now, what happens? So first, what we need to do in a cost sheet, we need to calculate all the costs that we are incurring. Now, visualize this stores area first. So the entire activity begins in this stores area. Now, what happens in the stores area? Now, first, let me put it up here. So what happens in a stores area? So first, what happens in a stores area, right? Now, at the beginning of the period, I have some opening stock of raw material, right? Fine. So whatever I purchased in the previous period and which I didn't consume will lie as an opening stock, right? Now, on top of this, in the current year, in the current period, I would have made some purchase of raw material, correct? Now, this is the total raw material available for consumption. Are you clear with this? Now, out of this, so let me just put this triple X here for the purpose of figures, right? Now, out of this, some portion of material could be consumed, direct material consumed, right? And some portion, the remaining portion of your raw material will be unconsumed, or in other words, that is called as your closing stock of raw material. Are you clear with this? Now, when I say this direct material is consumed, what do you mean by consumption? So technically speaking, these are the units or the kgs of raw material that will be transferred from the stores and it will now enter into the factory shop. Consume means what? They will be put into the machine, they will be fed into the machine, and these kgs of raw material are only getting converted into FG. So always remember, whenever they use the word raw material cost, it is not raw material purchased, it is raw material consumed. Why? Because we are talking about that portion of raw material that is being used to convert into an FG. Now, I could have purchased anything and keep it as a stock. No, that is not required. So, for us, the main figure required is what? The direct material consumed using which I am producing. Are you clear with this? So, basically here, what happens is, now this enters into the next area called as the factory shop. This enters into the next area called as factory shop. Now, in my factory shop, what happens? This direct material consumed will enter here. So, whatever is getting consumed will move out of my stores and will be entering into my machines. Are you clear with this? So, here what will happen is I will be having direct materials consumed. Are you clear with this, guys? Right? Now, apart from material, is the material only cost I incur? No. I will also be incurring direct labor. I will also be incurring direct expense. All these are incurred where? In the factory shop, or in other words, this is the area where the conversion happens. Raw material is converted into WIP, whereas the stores area exclusively deals in raw material. Are you clear with this? So once the materials are fed into my machine, what happens? Now, along with that, it will not automatically get converted into FG. Labor, direct expenses will also be incurred, and production overheads will also be incurred. What do you mean by production overheads? Production overhead means all the indirect costs incurred inside the factory. Are you clear with this? So all the costs, indirect costs incurred inside the factory is called as production overheads. We have seen this. So basically, what do you mean by the prime cost, as they call it? Here we've seen it, no? So what do you mean by prime cost here? Prime cost basically refers to all the direct costs incurred in the factory. Prime cost can happen only in the factory. Sir, what are all the direct costs incurred inside the factory? Only three are there: direct material, direct labor, and direct expenses. Direct material, you know, right? So, example for direct material. Suppose I am actually in the business of manufacturing cars, right? Let's say I'm Maruti Suzuki. Now, example of direct material is engine, right? For me to manufacture every unit of a car, I will be needing one engine, correct? Direct labor, that assembly line workers' wages. Example, one guy is fitting all the doors of this particular car. Now, for every door fitted, he will take 1 hour. A car has 6 doors, that is 4 doors plus one bonnet and dicky, 6 doors. So per car, he will spend 6 hours. Let us say per hour, I am going to pay him how much? 100 rupees. So now for every car, what will be the direct labor cost? So I need 6 hours into 100 rupees, 600 rupees. Clear with this? I can establish a direct relationship between this labor cost incurred and the output. Every unit of output, it is directly traceable to every unit of output. Are you clear with this? This is a clear-cut example of what? Of direct labor. Are you clear with this, guys? Right? Then direct expense. What do you mean by direct expense? Any other direct cost incurred in a factory that is not getting covered under direct material and direct labor. Clear with this, guys? So example, I will just give you. So here, prime costs, right? So prime costs. So we've seen this. Prime cost refers to direct material, direct labor, direct expense, right? These are the three direct costs that can be incurred. Direct material, we saw an example, engine. For a car manufacturing company, engine is a direct material. Labor, assembly line worker. Direct expenses, any other direct costs which is not getting covered under direct material and direct labor. Example, now I gave an example, even in a regular batch, I gave the same example, right? Maruti Suzuki. Let's take an example of Maruti Suzuki. So Maruti Suzuki, these are ideally speaking two different companies, Maruti Udyog Limited and Suzuki Incorporation of Japan. They have entered into a joint venture, and that's why all the cars are named as Maruti Suzuki. Now, the arrangement between these two companies is that now basically Maruti Udyog, the Indian company, will manufacture the cars using the technical know-how provided by Suzuki Incorporation of Japan. And basically the relationship between these two companies is that they have an arrangement for every car manufactured. Maruti Udyog should pay, let us say example, 50,000 rupees by way of royalty to Suzuki Incorporation. Are you clear with this? Now in this case, now this is an example of direct expense. Now Maruti Udyog should pay what? 50,000 rupees of royalty for every car manufactured, correct? To whom? To Suzuki Incorporated. Is it a direct expense? Yes. Why? Because it is readily traceable on a per unit level and it is incurred for the purpose of manufacturing activity directly. Are you clear with this? Now, is it covered under direct material? No. Can you call it as labor? No. Hence, you put it under the residuary direct expense figure. Are you clear with this, guys? Right? Anyways, we will be having a separate chapter on direct expense, a small chapter. So, Institute has given, we have a separate cost accounting standard that talks about direct expense, which we'll be doing next. Right? There I will be giving more examples relating to that. They have given a list of expenses that gets covered under direct expenses. Clear with this, guys? Right? So, that's about direct expenses. Now, right now, what do you mean by production overheads? Any indirect manufacturing cost. Are you clear with this? Meaning what? Any indirect expense incurred inside the factory. Are you clear with this, guys? Sir, can you give us an example? For example, supervisor's salary. Supervisor, who is a supervisor? That guy, there will be one guy standing in the factory shop with his hands tied. He will not actually put his hands and fit the doors and all. He will be overseeing the workers. He will be overseeing the assembly line workers. Now tell me, can I say for every car manufactured, right, I need 1 hour of this assembly line, I need 1 hour of the supervisor's time? No, I cannot come up with a relationship. He does not actually put his hands and work. However, without his presence, right, these guys will not properly work. So it is indirect labor. So indirect material, indirect labor, indirect expenses put together are classified under one bucket called as production overheads, which are incurred inside the factory. So overheads means indirect costs. Production overheads means indirect costs incurred inside the factory. Are you clear with this, guys? Right? Since it is incurred inside the factory, we will put it here. Are you clear with this? Right? Factory rent. It's another example of production overheads. What happens? I need to pay the rent irrespective of the number of units. Can I say for every 1 unit produced, I'm going to pay 2 rupees of rent? No. No, whether you produce anything or not, rent needs to be paid. However, it is incurred for the purpose of factory only, right? Inside the factory only. Hence, what I would say is, it is still a manufacturing related cost, but it is indirect in nature. Hence, I will park it under production overheads. Are you clear with this, guys? Right? These are all the costs that I incur. Right? Now, similarly, we are talking about what? We are talking about our WIP area. So, even in the WIP area, I can have opening WIP, right? And I can have what? Closing WIP. Are you clear with this? Right? So, basically, in this case, what happens? This is the sum total of all the costs incurred inside the factory shop, right? Using the cost that is being incurred in the factory Now, broadly, what has happened? So, using all these costs, by consuming all these costs, now what can happen? So, you can actually completely produce and transfer some units. That is, some units may be completed and transferred as FG, while some units will still be in the process of completion and will remain inside your machine as closing WIP. So here what has happened, this overall cost can be bifurcated into two. What and what? So one is your completed FG. One is your completed FG. That is, a portion of these costs are incurred towards what? Units completed and transferred as FG, while some units I would have started working on it, but at the end of the period I might not have completely finished it. That lies in your closing WIP. Are you clear with this, guys? Are you clear with this? So this is how it looks like. This is how it looks like. Are you clear with this? So now what happens? This completed units will now enter into my warehouse area, right? So in my warehouse area, which is basically the place where my FG is stored. Now, how does this warehouse area look like, right? So now these completed units, one second. So these completed units will enter into my, warehouse area. Now in this warehouse area, what has happened? Now I could also have some opening FG. Are you clear with this? Opening stock of finished goods, right? Of previous period itself I produced, but I couldn't sell it, right? I'm having it as a stock, right? Apart from that, current year I have produced this. So this is the total number of units available for your sale. This is the total number of FG that you have. Now out of this, what you can do, some units you can sell, some units you can remain, some units will remain as a closing stock of FG. So the units that you sell is called as COGS, which is nothing but cost of goods sold, while the units that are remaining unsold is called as closing FG. Are you clear with this, guys? Are you clear with this? So this is how it looks like. So now to sum it up, how it looks like is, so we need to, in the stores area, first we need to arrive at direct material consumed, right? So how will you arrive at that figure? Very simple. So you will take an adjustment of these three figures. I will say that it is opening stock of raw material plus purchases minus closing stock of raw material. If you do that, you will get the direct material consumed, because I'm only bothered about the amount of raw material cost that enters into my machines, that is my factory shop. Clear with this? This is the first segment of the format of cost sheet. Look at this. They have calculated direct material consumed. How have they calculated? Opening stock of raw material plus purchase or any other expenses related to purchase of raw material, right, minus closing stock. If you adjust these three, you will get what? Direct materials consumed. You get this figure, right? Now on top of this direct materials, what have they said? Add direct labor, add direct expense. Look at this. Add direct labor, add direct expense. Wait, the sum total of these three is called as prime cost. I told you, direct cost incurred inside the factory. Clear with this? Now one more cost is there. To this prime cost, add your POH. Look at this. Add your POH here. Now this is called as the total factory cost or as works cost. Are you clear with this? So the sum total of all these four is called as works cost or factory cost. Are you clear with this? So now I need to arrive at this figure, completed FG, that is the cost incurred in respect of units completed. Are you clear with this? Are you clear with this? So how will I do it? So here to this factory cost, add opening WAP and less closing WAP. Look at this. So what we need to do here is add opening WAP. So to this cost, add opening WAP, less closing WAP, or in other words, this net off figure, if you do, you will arrive at what? This value of units completed as FG. Are you clear with this? That they are calling it as adjusted works or factory cost. Why they are using the word adjusted? Because it is being adjusted for WAP, opening and closing WAP. We are doing the adjustment, no? This was called as the sum total of these four costs was called as what? Factory cost, right? To that, add opening WAP, closing minus closing WAP. Since you are adjusting it, it's called as adjusted factory cost. Are you clear with this? So now what happens? This ideally, this value of units completed, this is only called as what? This is only called as adjusted factory cost. We are giving it a name, adjusted factory cost. Now there is one small change here. This is the change between CA and CMA. What they are doing is this adjusted factory cost gets added up here, right? Adjusted factory cost, what they are doing is this adjusted factory cost, this figure enters into my what? FG area, warehouse area. Clear with this? Now what they are doing, over and above this, they are adding administration overheads. Sir, administration overheads is not incurred inside the factory, no. Administration overheads is incurred in only the corporate office. We are talking exclusively about the places inside the factory. Sir, why administration overheads is being considered here at the time when we are talking about the places inside the factory? You are right. This is the approach. That is, this is the approach. Adding AOH here at the warehouse area is the methodology that CMA Institute is following, right? But CA Institute says, no, you should not be added here. You add it separately. Clear with this, guys? So this is the clarification given here. Look at this. One second. Look at this. Okay, AS2 is not CAS, accounting standard 2, states that in determining the cost of inventories, it is appropriate to exclude certain costs and recognize them as expense in the period in which they are incurred. This includes AOH that do not contribute to bringing the inventories to the present location condition. If the cost sheet is prepared accordingly, the administrative overheads is to be added after calculating the cost of goods sold, not before. However, this has not been followed by ICMA study note. Rather, the traditional presentation of cost sheet has been followed. This note is there in the CMA Institute study material. They themselves have given, right? We are not following that. Hence, for the purpose of your exam, I'm strictly doing it for the purpose of your exam. So this point I've explained in depth in our regular batch, but since this being a revision marathon, I want to clearly focus it from an examination perspective. So CMA Institute says, look, no questions asked. We want this to be added here itself. Though it is incurred in the corporate office area, you put it here in the warehouse area and add it. So technically what CMA Institute says is, look, this is going to be the total value of what? This is going to be the total value of all the units produced, right? This is what they are saying. So look at this here. They are saying from adjusted factory cost, this figure, you add your AOH, right? And we are calling this as cost of production. Cost of production means what? The sum total of all the costs incurred to produce the units. Are you clear with this? Now, this will give you the units produced in the current year, right? Now, is that the only units you have? No, I also have opening FG. So add opening FG, right? Minus closing FG. If you net this off, you will get the cost incurred in respect of goods sold. Look at this. To this cost of production, add opening FG minus closing FG. You get what? Your cost of goods sold. So basically, this cost of goods sold is what? This is the cost that is incurred with respect of units sold. Now, the goods will move out of your factory. Now, what you need to do, to this you will add what? The other expenses incurred outside the factory. But wait, this AOH, administration overheads, was already added while arriving at our cost of goods sold. So this, once again, you need not add it now. You just need to add what? Your selling and distribution overheads. Are you clear with this? That is what they have mentioned here. To this cost of goods sold, add selling and distribution overheads. You get the final cost of sales. Cost of sales means what? The cost incurred in respect of the units sold. And to that, if you add profit, you will arrive at the sales figure. Clear with this, guys? Very, very, very logical. This is all it is, right? The only difference between CA and CMA is this manner of treatment of administration overheads. This is where I said admin overheads is treated as a period cost in CA Institute. It is treated as a product cost in our CMA Institute, right? Or in other words, administration overheads is considered for the purpose of arriving at the value of COGS. This is what they have given here, right? Calculating, look, administration overheads right now is being included for the purpose of calculating your cost of goods sold. Whereas technically, very strictly speaking, it should not be the case. It is a cost incurred outside the factory. Stock should always be valued at factory cost. Clear with this? A detailed explanation regarding this I have also given in our regular batch. Fine, for the purpose of exam, it's enough if you follow this. Clear with this, guys, right? And that's about the format of cost sheet. Now, let's quickly sum it up. So what is the format of cost sheet here? Opening stock of raw material plus purchases minus closing stock of raw material, you get your direct material consumed. Clear with this, right? You get your direct material consumed. To this, what will you do? So visualize this. Direct material consumed, add direct labor, add direct expense, direct labor, direct expense. You get your prime cost. To this, add your POH, this figure you add. Now you get what? Now you get your works cost, also known as factory cost. To this, what? Adjust, add your opening WIP less your closing WIP. You get adjusted works or adjusted factory cost. Now what you need to do, ideally this is all it should be, but one additional thing CMA Institute does, add your AOH. You will get the current year cost of production, right? Now you are entering into the warehouse area, right? This figure also gets added here. Now to this, add your opening FG less your closing FG. You get what? You will get your cost of goods sold. Are you clear with this? To this, finally, you add outside factory cost. Outside the factory, what are the other two places? Your admin and your selling area. Admin anyways is considered till right now here itself. Just add your selling and distribution overheads. You get your cost of sales, add your profit. You get your sales figure. Clear with this, guys? This is all about the format of cost sheet. Beyond this, what else is there, right? This entire chapter is being summarized now. This is all about this chapter. Please do not mug up. Fine. So now let's quickly go and do one numerical problem, one comprehensive numerical problem in this area. Now, the second question. So basically the material that I'm using here is our regular batch material, right? So we have done a lot of numerical problems in our regular batch. Nevertheless, in our for the purpose of our marathon, I've picked one comprehensive numerical problem and we are doing it here right now. Okay, so now let's get started here. The following figures were extracted from the trial balance of a company as on 31st of December 2022. Now they have given the opening stock of inventories. Sir, how do you know? They have just given inventories. How do you know it's opening stock? Very simple. The closing inventories, additional details, closing inventories of material, WAP and FG are given. So clearly when this is closing inventories, this has to be opening inventories. Are you clear with this? That's all. So first they have given what? Opening stock details of opening stock of raw material, WAP and FG. Now immediately tell me, where will these appear in your cost sheet? Where will these appear in your cost sheet? Now you have respective figures, you have respective stock adjustments. No, these are separate line items, right? So opening stock of raw material plus purchase minus closing stock of raw material, right? So opening stock, closing stocks of raw materials are there. Similarly, WAP, opening, closing WAP, these are separate line items. So that need to be plugged in the respective area. Similarly, here opening, closing FGs and all, you need to plug it up. The figures are given. Next, office appliances. What do you mean by office appliances? So these are some assets used in the corporate office area. Basically, the depreciation on these office appliances should be taken as AOH and it should be parked under the AOH category wherever it comes. Next, plant and machinery. This is again not a cost, it's an asset. Depreciation on plant and machinery should enter into what? It should be considered as your production overheads, indirect manufacturing cost. Then buildings, 2 lakh rupees. Building is an asset, but they have not given properly whether this building is going to be what. This building is going to be an office building or a sales depot related building, or what it is going to be a manufacturing factory related building. Now based on that data, we need to determine the depreciation on the building should fall under the respective category based on its usage. Always remember, it's very simple, it's location specific. If it is a factory building, depreciation on a factory building will be treated as POH. Depreciation on office building treated as AOH. Depreciation on sales building treated as what? SOH. As simple as that, right? We will be seeing it. Next, sales figure is given, sales return figure is given. Net of these two figures, then you will be getting what? The sales figure. That's all. Then raw material purchased, separate line item. Now freight on materials purchase. Now this should also be added along with that raw material purchase. Why? Always remember, when I say raw material, purchase cost of raw material, it should consider all the costs incurred to bring the raw material to my store's area. Are you clear with this? So the raw material purchase cost plus the freight on raw material, then you have some purchase return also. Net these three things off, you get the net purchase cost that needs to be added. Clear with this, guys? Next, direct labor, separate line item. Indirect labor, this comes under what? Production overheads. Clear with this? Factory supervisor, once again production overheads. Factory repairs and upkeep, is it direct or indirect? Indirect. Where is it incurred? Factory they have given, so this is also POH, production overheads, right? Heat, light and power, 65,000 rupees. Now where is it incurred? Now they have given one note, we will read it. Based on that we will see. Rates and taxes, similarly, for what purpose you are incurring. So let's read a note. Once we read the note, you will understand that. Miscellaneous factory expenses, once again it's going to be POH. Clear with this, guys, right? Then sales commission, selling overheads, it's a selling related expenses. Next, sales traveling, SOH. Sales promotion, SOH. Distribution department salaries and wages, selling related only. Office salaries, it's AOH. Now very important, interest on borrowed funds. Where will interest on borrowed funds come? Interest on borrowed funds will not at all come in our costing subject. Why? Because if you see in our costing subject, only the costs incurred in any of these three locations will be considered. That is your factory or your corporate office or your sales depot. But for this, no other cost. Did you see interest and all in your cost sheet? Not at all. Or in other words, here in costing, we only consider the operating expenses. Non-operating expenses are not considered in costing, they are considered in FM. Sir, then we are ignoring, sir? Yes, we are ignoring. So then the profit reported here is wrong? No. The profit that we report in costing is not net profit. It is called as operating profit, also known as what? EBIT. Are you clear with this? Right? So costing stops here. From here only, minus interest you do, you get EBT, minus tax you do, you get EAT and all. These are subject matter of financial management, or in other words, we can say FM starts from the point where costing ends. Are you clear with this? Costing reports only operating profit. Any kind of non-operating income and expense are completely ignored in our costing. Are you clear with this, guys? Please have this in your mind. Clear with this. Now, what have they given? Closing stocks of raw material, WIP and FG is given. accrued expenses are direct labor 8,000, indirect labor 1,200, and interest 2,000. So direct labor, so 1,60,000 is the amount paid. Over and above that, you have 8,000 rupees of direct labor, right? So technically speaking, another 8,000 rupees. This will also be considered. We always follow accrual concept. This is what outstanding that also needs to be added as a cost. Then indirect labor is 1,200, so plus 1.2k indirect labor. Then you have your interest cost. Okay, interest 2,000 plus another 2,000 that needs to be added. Depreciation should be provided as 5% on office appliance, 10% on machinery, and 4% on buildings. So 5, 10, and 4. Look at this. So here it's going to be at the rate of 5%, at the rate of 10%, at the rate of 4%. Clear with this, guys? Next, what have they given? Heat, light, and power are to be distributed in the ratio of 8:1:1 among factory, office, and distribution respectively. Look at this. What they are saying, heat, light, and power. This cost is there, no? Right? So this is a common cost incurred for what? Incurred partly for the purpose of production, partly for the purpose of administration, partly for the purpose of selling and distribution activity. In what ratio? 8:1:1. So what we will do, 65,000 divided by 10 into 8 is equal to how much? So it's going to be 52,000 rupees, right? 1 by 10, how much is this? 6,500. And here 1 by 10, 6,500. So basically what we will do, this 65,000 rupees out of this 52,000 will be treated as production overheads, 6,500 is treated as administration overheads, and 6,500 will be treated as your selling overheads. Clear with this, guys, right? That's about it. Next, rates and taxes apply 2/3 to factory and 1/3 to office. So now what they are saying, rates and taxes, so 2/3 to factory POH and 1/3 to what? Office AOH. Are you clear with this? Right? So 6,300 divided by 3, that's 2,100 into 2 is equal to, so 4,200 rupees is attributable to production overheads, and 1 by 3, 2,100 rupees is attributable to what? It is attributable to your administration overheads. Are you clear with this? Then depreciation on building is to be distributed in the ratio of 8:1:1 among factory, office, and distribution respectively. What they are saying, now look at this, office appliance depreciation on that is fully AOH, right? Plant and machinery depreciation on that, plant and machinery, where will it be? It's fully production related. Building is a common area. What they are saying, with respect to building, right, whatever is the depreciation, so 2 lakh into 0.04, this 8,000 rupees of depreciation, what you need to do, split it between factory, that is POH, corporate office AOH, and your sales depot SOH in the ratio of 8:1:1. This is what they are saying. Maybe it's a common building used for all the 3 locations inside a factory. So what we need to do here, I mean all the 3 locations, that is for factory as well as for administration office as well as for your sales depot. So in that case, what you need to do, 8,000 rupees worth of your depreciation should be bifurcated, should be apportioned between these 3 in the ratio of 8:1:1, and accordingly you need to take all these expenses. So now what we need to do here is, in this question, we need to first prepare the statement of cost sheet. We need to take the respective cost. The correct cost should be taken under the correct category, and we need to prepare the cost sheet. That's about this entire question, guys. Are you clear with this? Right? This is all about the question. So now let's quickly do the solution for this particular question. Now look at this. So first, what happened? Statement of cost sheet. It starts with what? Opening stock of raw material. So how much is the figure? The opening stock of raw material was given as what? 1,40,000. So this figure, we have got it here, 1,40,000. Now I told you, add purchase figure should be added. Freight figure should also be added, less returns. This should also be taken into account. Clear with this? So basically, these 3 figures should be considered as your net purchase cost. Are you clear with this? Right? So opening stock of raw material plus your net purchase cost minus closing stock of raw material. If you do that, how much you get? 1,40,000 plus 320,000 plus 16,000 minus 4,800 minus 1,80,000. You get how much? 2,91,200. This is the value of raw material consumed. Are you clear with this? Now, over and above that, what you should do? Direct labor. How much is direct labor? Tell me the figure. It's 1,60,000 plus 8,000 accrued they have given. Correct. So it's going to be 1,68,000. You get. Now, direct expense in this question, direct expense is not there. You can leave it. That's about it. Clear with this. You get your prime cost. Now, to this prime cost, what you need to do, add your factory overheads. Now, predominantly in most of the sums, there will be multiple components of this factory overhead only. Now, what are the different components of factory overheads here? Look at this. So, first, indirect labor, how much is it? 18,000 plus 1,200. Correct? So, 18,000 plus 1,200. Are you clear with this? Then, what other figure we've got? What other figure we've got? Supervision, 10,000 rupees. Factory repairs and upkeep, 14,000 rupees. Look at this, 10,000 and 14,000 rupees. Clear with this, guys? Then you have this heat, light and power, 65,000. However, the entire 65,000 is not factory oriented. Only how much? 8/10 of it. So 8 by 10 into 65,000. 52,000 rupees alone is your production overheads at, the factory heat, light and power attributable to your factory, 52,000 rupees. Are you clear with this, guys? See, all the figures, you just need to keep adding it up. That's all. Next, rent and rates and taxes. It's a common rates and taxes. So out of this, how much? 2/3 of 6,300, which is 4,200, is attributable to my POH. So just add this figure here. So it's going to be 4,200, right? Then what other expense is here? You've got miscellaneous factory expense to the tune of how much? 18,700. So that also can be added here, 18,700. Are you clear with this, guys? Now, apart from this, depreciation we need to take. What is the depreciation on plant and machinery? So 4,60,500 into 10%, just remove 1 0. 46,050. That's the depreciation on plant and machinery. Look at this. This is all it is. Clear for this, guys? Next, your buildings, 4% on 2 lakhs. So 2 lakh into 0.04, it's going to be 8,000 rupees, right? 8,000 rupees of what? Depreciation should be apportioned between your factory, admin and sales in the ratio of selling overheads in the ratio of what? 8:1:1. So 8,000 divided by 10 into 8 is equal to, so 6,400 rupees. 1 is equal to 800 rupees for AOH, 800 rupees for SOH. So now this 6,400 rupees is the depreciation on building attributable to my factory. Clear with this? Look at this. This is going to be 6,400 calculation. So 4% on 2 lakh into 8 by 10. Clear with this, guys? So this is the sum total of all my entire factory overheads. Clear with this? On this, add your opening WAP less your closing WAP. These two figures are given. So now whatever figure you get, that's going to be your, so prime cost plus your POH, right? Prime cost plus your factory overheads, right? That's going to be your entire works cost. On that, what do you get? Your adjust for your opening and closing WAP. Technically, this is called as adjusted factory cost and all. That is the figure here. Are you clear with this? To this, what we need to do now, add administration overheads. Administration overheads, how will you add? First, heat, light and power, 65,000 rupees. On that, 1/10 was attributable. So the 6,500 rupees that we calculated here, the 6,500 rupees should be added up here. Are you clear with this? The 6,500 rupees should be added up here. Similarly, rates and taxes, 6,300 rupees into 1 by 3. This figure, 6,300, 1/3 of that, 2,100. This needs to be added up here. And one more thing, depreciation on buildings we saw, right? So there, the building is a shared area, right? So 4% on 2 lakh, that was 8,000. And on that, right, 1/10 of it comes to your AOH, that's 800 rupees. Right, so that's going to be 800 rupees. Then depreciation on office appliances that we already saw here, it's going to be 5% on 17,400. So it's going to be 0.05 on 17,400. It's going to be 870 rupees. Look at this, it is 870 rupees. Your office salaries, this figure was given as 8,600. Let us tick it off. 1 second. Yes, office salaries is going to be 8,600. Are you clear with this? This figure is also done. This is going to be a total of your AOH. You add it up, you get your cost of production. Now to that, add your opening stock of FG less your closing stock of FG. Like this is the net figure. right? You get what? You get your cost of goods sold. Now to this, add your selling overhead. Selling overheads, the balance of your heat, light and power, right? The balance of depreciation on building. Apart from that, we had some separate line items: sales commission, sales traveling, sales promotion, distribution department, salaries and wages. You add it up, you finally get your cost of sales. Are you clear with this? So now what you need to do, this ideally the cost sheet stops here. Now what they have done here, they have prepared what your financial P&L, not your costing P&L. They have prepared a financial P&L wherein they have taken sales 7,68,000. We saw this figure was given, minus sales returns of 14,000 rupees. Net sales was how much? 7,54,000 rupees they have taken. From this, all the costing related cost is 7,14,020. This they have directly knocked off here. Cost of sales, right? And one more thing, now they have taken the non-operating expense. What was that? That interest on borrowed funds. How much is it? 2,000 plus 2,000. This 4,000 rupees of non-operating expense has now been considered here. They have arrived at the final net profit. So technically speaking, 7,54,000 minus 7,14,020. How much is this? 754,000 minus 714,020. If you do, you get how much? 39,980. This is ideally called as your operating profit, right? From this, you further reduce this 4,000 rupees. This is ideally considered only in your FM, right? So this 4,000 rupees you reduce. Now you get a net of how much? 35,980. This is your net profit. Are you clear with this? Or even your accounting profit, you can call it as. Are you clear with this? 35,980. This is ideally the figure reported by costing. And after adjusting for this 4,000 rupees, this is the final net profit figure. Are you clear with this, guys? This is all about this entire chapter. Beyond this, nothing is there in this chapter. Very, very simple. First, you need to know the format. Number two, you need to know the logic behind the format. And number three, we have done one full comprehensive problem in this regard. And with this, we have completed this particular chapter. Are you clear with this, guys? Right? Have the confidence. Just revise it once and you will be through. Now, with this, let's move on to the next chapter. Now, let's get started with the revision of the next chapter called as direct expenses. Now, guys, this is a very small chapter, right? But at the same time, it is pretty much important. Sir, will this chapter get tested separately? The chances are it might get tested separately, or it can be combined along with your cost sheet chapter. So how can it be combined with cost sheet chapter? Some adjustments they might be giving, some direct expense component. Now you need to properly classify those line items under direct expense. Clear with this, guys, right? Now we will be we will be revising this chapter right now. But remember one thing, generally students get confused when a direct expense line item is given. Students will be confused whether to classify it as direct expense or to classify it under POH. Generally, the confusion is a particular line item shouldn't be classified under direct expense or POH. This confusion will only be there. No other confusion will be there. For example, there will be no confusion as to whether a line item has to be direct material or direct expense. Or there will be no confusion as to whether you need to classify a particular line item as direct labor or as direct expense. No, this confusion will not be there at all, because direct material you clearly can identify, direct labor can be clearly identified. The question comes only with respect to expenses, whether it needs to be a direct expense or an indirect expense. Indirect expense goes to your POH. Now, what is all these things? I will just quickly summarize and we will quickly revise this entire chapter. Now, guys, this particular chapter, direct expense, is covered under a specific cost accounting standard called as CAS 10. Clear with this, guys? Now, just to give a context, so the cost accounting standard, right, are prescribed by CMA Institute, our CMA Institute, and as on date, there are 24 cost accounting standards prescribed by the CMA Institute. In that, one of the cost accounting standard is CAS number 10, which deals in direct expenses. Clear with this? Now, just to set the context right, now we saw that there are three locations in a company. What are the three locations? Factory, then you have your corporate office and your sales depot. In that factory, there are multiple locations, all these things we saw. Now, first, the costs incurred inside a factory, common word is called as manufacturing cost, right? It's because the manufacturing activity happens in a factory. Any cost incurred inside a factory is called as manufacturing cost. Now, manufacturing cost can be broadly classified into material costs, wage cost or labor cost, or expenses, right? Now, each of these categories can be further categorized into direct component and indirect component. Material cost can be direct material cost or indirect material cost. Labor cost can be direct labor or indirect labor. And expenses can also be direct or indirect. Now, let me just quickly give you an example. Let's say a company, Maruti Suzuki, is in the business of manufacturing cars. Now, for them, an example of direct material would be your engine. Every car requires one component of engine. It's a very integral part of the car itself, right? And I can come up with a direct relationship. It can be directly traceable on a per unit level, correct? Indirect material, can you give us an example? Example is this lubricants. Now this lubricants, right? Why do we use lubricants? We use the lubricants so that the machines will run properly. Only if the machines are running properly, the lubricants will be applied on the machines, right? So only then the machines will run properly. Only if the machines run properly, you can actually produce the products. Are you clear with this? These lubricants are not directly present in the car that is being sold. However, without the presence of these lubricants, the production itself cannot happen. That's why it's an indirect material. So lubricant is a material, right? You actually can see it. It will be in tins or it will be in can. You have seen this Castrol, Mac, and all these things which we use for our bikes and cars. These are engine oils, right? Similarly, there will be some kind of lubricants, your grease, and all these things will be there for the purpose of running your machineries. Are you clear with this? Wage cost, direct expense. Assembly line workers' wages is a direct expense, direct wages, whereas the supervisor salary, right, that is going to be indirect wages. Now, expenses can be classified into two. Direct expense, example, I gave you royalty, right? Royalty. In our regular batch, I gave you two examples. One is Maruti Udyog Limited paying to Suzuki Incorporation. The other one is that Renault's example. Renault's, the company called Rorito, right? For every unit of pen they sell, right, a 10 rupee pen, let's say they need to pay 2 rupees to Renault's. Currently, that Renault's and Rorito joint venture is over. It's not there. That's the reason why the same, whatever pens that you were purchasing back, 5 or 10 years back, whatever you're purchasing the name of Renault's are now being sold in the name of Rorito because the joint venture agreement is not there. As simple as that. Clear with this, right? A royalty payment is an example of direct expense. Indirect expense example is your factory rent. Are you clear with this, guys? Right? So for each of the components of cost, I've quickly given you an example. Now, this direct components of cost incurred in a factory, basically your direct material plus direct wages plus direct expense put together is called as a prime cost. Clear with this, guys? And your indirect material plus indirect wages plus indirect expense put together is called as your production overheads. This is how it appears in your cost sheet. We have seen this. Your direct material, direct labor, we have a component called as direct expenses. Correct? Similarly, after the prime cost, you had POH. POH is nothing but indirect material plus indirect labor plus indirect expenses. Are you clear with this? So on the face of cost sheet, the direct items, the direct cost items will be appearing separately. Direct material, direct labor, direct expense. Whereas the indirect manufacturing cost will be clubbed together and appearing as a single figure called as POH. Your indirect material plus indirect wages plus indirect expense clubbed together will be called as POH. This is a background that I want to give. Now, this chapter talks about which are all the expense that needs to be categorized under the direct expense category. Your cost accounting standard 10 talks about it. Now, if you look at it in your institute study material, even in our handbook, which I've kept it as such, right? They have just mentioned it in a huge list and all. They have just mentioned it. Now, very simple. Let me just summarize and put it here, which I have done here. I have summarized and I've put it here. Examples of direct expense as per cost accounting standard 10, right? For all the numerical problems solving, right? And even if it comes as a theory, you remember these 6. These are the repeatedly tested areas, which I am quickly summarizing it. Now, examples of direct expenses. Now, if you find any of these items, right, it needs to be necessarily classified under what? Direct expense category. Do not put it under production overheads. Clear with this. First, royalty payment. Just an example I gave you. Maruti Suzuki and your Renault's pen example also gave you. Next, next, job charges. What do you mean by job charges? Right now, let us say I am in the business of pen manufacturing. I manufacture pens. Okay. Now, what happens? Suddenly, I'm getting a huge contract, right, to manufacture 1 lakh pens. It's a very big contract. But what has happened? All my laborers are only fully occupied because I normally whatever is the business because of which I'm already carrying on my activity. Suddenly, one big order comes. Now, what I do? I cannot say no to this order, right? And I cannot also say you go to my competitor and you do it. No. What I will say, I will undertake the order. Now, what I will do is I will purchase the material, right? So for me to manufacture pens, what are the materials I will be needing? Your plastic, your refills and all these things I will be needing, the cap and all that. Now what I will do, I will purchase the raw material. Can I use my labor? No. Why? Because they are already occupied with the current business activity, my current workload. What I will do is I will call one contractor and I will say, look, I want you to manufacture 1 lakh pens, material related, whatever is the material I will give you. You just use your workforce, convert this RM into FG and give the FG to me. I will give you the raw material, you convert it into FG and give it to me. Now tell me what will be the cost for converting this RM into FG, right? He will say, for me to convert this RM into FG, you will have to pay me 6 rupees. This 6 rupees is the price that he charges for what? For using his factory, right, his labor workforce and for conversion activity. So I will give him the material, he just does the conversion activity and gives it to me and I will finally sell it. Are you clear with this? Are you clear with this? Now in this case you tell me, now this 6 rupees is the amount that I paid to the contractor for what? Converting this raw material into FG. Yes, and for every unit he is converting this raw material into FG, I need to pay him 6 rupees. Now you tell me, can I classify this as a material cost? No, I incur material cost. I give him the material. I incur the material cost and I give him. It's clearly not material. Can I call it a direct labor? It's not direct labor. Direct labor means when I'm using my workforce and the amount that I pay them is called as direct labor. Now, this outsourcing amount that I pay him is called as a job charge. I give him a job, right? What is a job? Convert my RM into FG and supply it to me. The charge for me, for the charge that he actually bills me to complete this job is called as a job charge. Now, in this case, for every unit is charging me 6 rupees. It's clearly traceable on a per unit level. Are you clear with this? Hence, this can only be classified as a job charge. Are you clear? I mean, this can only be classified under direct expense. This is the example that I'm giving you, the contract outsourcing example. Are you clear with this, guys? Right? So if you find job charges anywhere in your full-fledged cost sheet problem or anywhere at all, it should be classified under what? It should be classified under your direct expense. But some students, what they do, without knowing the concept of job charge, they put it, okay, this is not direct at all. So any indirect cost incurred inside a factory gets parked under POH. They do it. No, it should not come under POH. It should come under your direct expenses. Now, the remaining 4 are related to your job costing industry. Job costing industry means what? I told you, right? These job costing industries are basically the industries which focuses on serving customer specific product. I gave you an example of Casa Grande and all that, right? Now, ideally speaking, these next 4 points will come under the category of what? It comes under the category of your job costing sector. Are you clear with this? What is this? Higher charges for use of a specific equipment for a specific job, special designs or drawing for a specific job, softwares specifically for a job, traveling expense for a specific job. Now, what they are saying is, look at this. Let's say I'm in the business of manufacturing machineries for my client, right? Now what happens? I have 2 clients. One client is a pen manufacturer. I need to manufacture machines for a pen manufacturer. The other client is, let us say he is into the business of textile manufacturing, right? He's into the business of textile manufacturing, and I need to come up with a machinery that is suitable for his business, textile manufacturing. Now, clearly, this is an example of a job costing sector. basically what is the unique nature of job costing sector here in this case. So the cost needs to be specifically identified and you need to calculate it separately. I cannot calculate it by averaging out. Now what happens for this textile manufacturer client that I have, right? So for me to manufacture the machines needed for this textile manufacture, I use a specific equipment, power tools. I use some specific tools like drilling tools and all that to come up with the product that is usable by him. Clear with this? And for me to actually see, all these things are very big jobs. It will not happen overnight, right? For me to actually come up with the machines that is usable for the textile manufacture, first I need to hire one guy called as, the valuer, or I need to have a domain expert, a person who is an expert in the field of all this manufacturing, machinery manufacturing. I need to call him up and I need to draw the design for his very huge machinery that I'm going to manufacture. In this case, for me, the machinery is my stock in trade. I mean, it's my stock basically. I'm going to manufacture that and sell it, right? For that, first, I will have to, hire a person, and specifically for this job, he will give me the drawings and all that, right? And maybe for me to come up with this particular job for this particular client, I might be using some specific softwares, and I might have to travel to his place. Let's say he's in Japan and I need to go to his place and come back. So certain costs are incurred specifically for the purpose of a particular job. Now those costs are all, I cannot, obviously it is a direct cost, but can I classify it as direct material? No. Direct labor? No. So it clearly comes within the ambit of direct expense. Are you clear with this? This is all you need to know. But one very important thing is these four costs are all coming under the category of job costing sector. Now in your institute study material or nowhere, they have not given this explanation, number one. Number two, wherever you find the word is specific, that is specific higher charges. If you find specific designing or drawing costs, your specific software costs, if they give you the word specific, then categorize it under your direct expense. Simple reason, the moment they are saying specific, it means it is for a particular job. Then it is directly traceable. Then it is an expense directly traceable to a job. It's a direct expense. It's not an indirect expense. Are you clear with this? Logically, an easy way to remember, just do it. This is the logical way also to remember. Are you clear with this? Right? This is all this chapter says. Nothing else is there in this chapter. Clear? Let's quickly do one question and finish it off. Let's quickly do one question. Now look at this. Look at this. Royalty paid on sales 30,000. Royalty paid on units produced 20,000. Higher charges of equipment used for production 20,000. Design charges 15,000. Software development charges related to production 22,000. Compute the direct expense. Basically, just add these four and that's about it. But that's not the reason I'm doing this question. Here, they have given a note that is the main reason I'm doing it. See, they have just added whatever is the expense given in the question and they have just arrived at the total direct expense. But look at this. Expenses are related to either manufacturing of a product or service, right? Number two, these costs are directly identifiable and can be linked with the cost object. Cost object means what? The object for which I'm computing the cost, in this case a unit, and are not related. These are direct costs but not categorizable under material or labor, and hence I am categorizing this under direct expense. Hence these costs are considered as direct expense. Are you clear with this, guys? This is all the chapter says. Very, very small chapter. Ideally speaking, this shouldn't be a separate chapter. It should have been a part of your cost sheet chapter only. But nevertheless, since they have given it as a separate chapter, I have also discussed this here. That is all about this chapter. So what you need to remember is only this much. The first thing is that, so royalty payments, job charges, and your higher charges for specific equipments, your special design drawings, your software specifically for a particular job, the traveling expenses for a specific job, these are all ideally the cost that comes under the category of direct expense. And with this, we have revised this chapter, a very small chapter. Clear with this, guys? Right? Now let's move on to the next one, standard costing. Right? Now, guys, before we move into this particular, the revision of standard costing, now let me tell you a few things about this chapter. Number one, this chapter standard costing is a common chapter between paper 8 cost accounting and paper 12 management accounting. But in terms of syllabus wise, in cost accounting, there is only very limited portion of this chapter. Whereas in management accounting, the entire chapter, the entire concepts involved in standard costing is there. That is number one. Number two, now in this chapter, if you have attended a regular batch, you will definitely be able to appreciate the statement. This is the biggest of all the chapters in our CMA Intermediate paper 12, right? This is the biggest of all the chapters because we have done about 50 numerical problems, 50 plus numerical problems. You've covered it in our regular batch. Now, this being a revision lecture, revision marathon, what I will do is I will touch upon all the concepts involved in this particular chapter, right? And we will be revisiting all the formulas that were covered in our regular lectures as well as, right, that is there in your syllabus. We will be covering every single thing, right? And finally, what we will do is we will do one full comprehensive numerical problem covering all the cost side variances as well as the sales variance. So this way it will be a super revision or what do you call, a very good way of touching upon all the major concepts involved in this particular chapter. Are you clear with this, guys? Right? So now one more thing I want to tell you before we enter into this chapter. In our paper 12 management accounting regular batch, I had asked you guys to prepare one full chart, right? Writing down all the formulas that we learned in this chapter, right? And I asked you guys to write it by yourself without mugging up logically. And remember, I also asked you guys to write that hashtag standard costing is logical and all of that, right? I'm happy to note that some students have done this, right? Now, if you have that chart which you have prepared, right, so you please have that with you right now. Anyways, I have prepared it for you guys, and a copy of this, PDF copy of this will anyways be provided in the description below, right? So you can download it. But if you have prepared it, nothing like it. That is the best way to actually revisit this entire chapter. So now that is going to help us out. And we have also seen, I've proved it to you guys that not even a single formula in this entire chapter needs to be mugged up. Even in this revision marathon, I will be explaining all the logics of each and every formula in a very quick manner, because it can't be too much detail because this is going to be a marathon. Clear with this, guys? Fine. So on that note, let us get started with this beautiful chapter called as standard costing. Now, what is this chapter all about, right? Now, at the beginning of a financial period, right, a company prepares budget and they will arrive at the budgeted profit, which means what? The profit they are planning to achieve. Now, after the end of the period, now the company takes into account whatever is the actual sales minus actual cost, all these things, they will arrive at the actual profit. Now, the budgeted profit and the actual profit will definitely not be the same. Now, there will be a difference between the two, and this difference is called as profit variance. Are you clear with this? What do you mean by variance? Variance means difference, right? The difference in profit. Now here, if you just report, yes, so and so is the amount of profit variance, that is not enough. We need to know why, what were the reasons that were resulting in this particular profit variance. That is the study of this entire chapter called as standard costing. Now, the profit variance is attributable to two broad reasons. One is the variances happening on the sales side. The other one is the variances happening on the cost side, right? So sales variances and cost variances. Now, if you further dig into it, cost variances can be further classified into four broad categories. It could be material cost related variance, labor cost related variance, variable overhead cost related variances, or fixed overhead cost related variance. Are you clear with this, guys? Yes. Now, in this particular CMA intermediate syllabus, right, if you are a student who is appearing for paper 8 cost accounting, in your syllabus, you have only material cost variance, labor cost variance. That's about it. Whereas if you are a paper 12 management accounting student, right, if you're writing the second group, in that case, all the variances are applicable. That is material cost variances, labor cost variances, variable overhead cost variances, fixed overhead cost variances, and even the sales side variances. We will see in sales side variances, there will be two different methods. One is called as a total approach. The other one is called as a margin approach. The entire subject, the entire chapter is applicable for paper 12 students. For paper 8 students, only these two variances, material and labor related variances are there. Are you clear with this, guys? Yes. Now, one more thing one more thing. In this chapter we will be using two terminologies. One is called as a favorable variance, the other one is called as an adverse variance. What do you mean by a favorable variance? Any variance that results in increasing your profit is called as a favorable variance. Any variance that results in decreasing your profit is called as an adverse variance. Are you clear with this? For example, we are talking about material cost, right? Let us say you should have incurred 100 rupees, right? Standard material cost, whereas you have incurred 110 rupees actual material cost. In this case, there is a 10 rupee variance. But if I just mention 10, it is not sufficient for the purpose of decision making. I should say whether this 10 is a favorable or an adverse variance. You tell me you should have incurred 100, you have incurred 110, so you have incurred more cost. This results in reduction of your profit. This is an adverse variance. Are you clear with this? Whereas suppose you should have incurred 100 rupees, you have only incurred 90. This case also there is a 10 rupee variance, but that 10 is a favorable variance. Are you clear with this? Right? These are some basic things that you need to know. Clear with this, guys? Now let us get started with the material cost variances. Clear with this? Now this entire chart, that's about it. You will be able to completely finish this material cost variances. Now first I will do all the formulas, all the concepts that are involved in this chapter, and as I told you, we will do one full comprehensive sum where we will be applying all these formulas logically. Clear with this, guys? Right? Now if you are attending if you are learning standard costing for the first time, now this might not be fully sufficient. As the word suggests, this is a revision marathon, right? So the prerequisite for you to watch this particular marathon is that you should have already studied this entire concept of standard costing once. Now the whole purpose of this revision marathon is to help you recapitulate the entire chapter in a fraction of about what, 1 hour or 1 hour 15 minutes, or whatever it is that we are going to take to finish this particular chapter. Clear with this, guys? So now let us get started. Material cost variance. Now by the way, guys, we all know all the cost side variances. So what is basically the variance? The standard cost minus actual cost. Basically what? The cost that you should have incurred versus the cost that you have actually incurred. Only that we can compare. Are you clear with this? Now guys, in this case, material cost variance, what is the standard material cost? Which means what is the material cost you should have incurred? Standard quantity into standard price. What do you mean by standard quantity? To produce the actual production, how many kgs of raw material I should have consumed. Clear with this? Multiplied by, so per kg of raw material, what is the price I should have paid? This is the meaning. This has to be compared with what is the actual kgs of raw material I have consumed with what is the actual price that I have paid. Are you clear with this? Now this is broadly classified into two: price and usage variance. Now material cost variance, if I just publish this figure, it is not enough. Now immediately what will the managing director ask? Now who is responsible for this variance? Now in this material cost variance, it could be the responsibility of two parties. One is the material price variance, the other one is called as the material usage variance. Now come on, tell me, who is responsible for the price variance? Obviously the purchase manager. Clear with this? And who is responsible for usage variance? Usage variance is the responsibility of production manager. Now look at this. Purchase manager, what is he responsible for? He is responsible for purchasing the kgs of raw material. Now his responsibility lies in what? Negotiating the best deal for the company, correct? So what comes under his ambit? Standard price minus actual price. Let us say per kg he should have paid 10 rupees. But what has happened? This fellow has paid 11 rupees. Are you clear with this? For every kg of raw material, he has paid 1 rupee more. Are you clear with this? So now I'm clearly pinning out the responsibility on the purchase manager into actual quantity. Why am I multiplying this with actual quantity? Because this purchase manager has authority only to fix the price at which he can purchase. He has no control over the quantity that requires to be purchased. Why? Because it is the production manager who tells him how much quantity that he needs to purchase. Are you clear with this? Whatever quantity that the production manager tells, those many quantities he need to purchase at his particular discretion, that is what his particular price. So his responsibility lies only with respect to the price. Multiply that with whatever actual quantity that he has been asked to purchase. So here the purchase manager is actually dependent on the production manager for the quantity decision. Are you clear with this? Now moving on to the other side, material usage variance. In this case, who is the person that we're talking about? Whose responsibility we're talking about? So production manager, what is he responsible for? He is responsible for consuming the raw material. So standard quantity, that is the kgs of raw material he should have consumed, minus actual quantity, the kgs of raw material that he has actually consumed. Clear with this, guys? Into what? Now this is in kgs. We need to convert this figure into a rupee value. So multiplied by standard price. So why here alone standard price? Because look, the production manager is not dependent on the purchase manager. Are you clear with this? Suppose I multiply this with actual price. What happens? The efficiency or inefficiency of the purchase manager gets passed on to the production manager. So I should not do that. Hence, I multiply this only with the standard price. Are you clear with this? This is the beautiful logic involved in standard costing. Many people are mugging this up. Please do not mug this up. Clear with this, guys, right? So now what is the formula here? Standard quantity minus actual quantity into standard price. So clearly remember here why we multiply the price variance with actual quantity, because the purchase manager is dependent on the production manager for the quantity decision. Whereas here in usage variance, we only multiply with its standard price and not with the actual price. Why? Because the production manager is not dependent on the purchase manager for anything. Are you clear with this, guys? There is a one-way traffic. This is what I told in our regular lectures also. Clear with this, guys? Material usage variance. Now, usage variance alone is not sufficient. Suppose the company uses more than one type of raw material. Now, in this case, what happens? This usage variance is further classified into two: material mix variance and what? Material yield variance. Material mix variance is what? Revised standard quantity minus actual quantity into standard price. Clear with this, guys? So basically it is what it shows about, right? There are three types of raw materials: raw material A, B and C, right? Now overall maybe the quantity that I consumed would have been correct, but inside this I would have used more of a costlier raw material, lesser of a cheap raw material, or I would have used more of a cheap raw material, lesser of a costlier raw material. Now because of the deviation in the mix, how much is the amount that is attributable to the usage variance is what gets tracked down here in my material mix variance. Are you clear with this? And material yield variance is what? It is the balancing figure. Now look at this. We need to arrive at this figure: standard quantity minus actual quantity into standard price. Yes, on one side we have what? Revised standard quantity minus actual quantity into standard price. So this is going to be the balancing figure. It's going to be standard quantity minus RSQ into standard price. Or in other words, what you do, if you add up this two, that is, if you add up this two, what happens? RSQ and minus RSQ, it gets cancelled. Now what happens? Finally you get what? Standard quantity, you get this figure, minus actual quantity, you get this figure, the whole into standard price. So you get your, as I call it, daddy figure. That is the top figure, you will get it. Are you clear with this? Or in other words, you need not remember this. You can take this down as a balancing figure. Are you clear with this, guys? Right? So that's about this particular area. And of course, I told you this particular yield variance also has two other formulas. One is what? The actual yield minus standard yield into standard cost per unit, right? The other one is standard loss minus actual loss into standard cost per unit. Are you clear with this, guys? These are some really big derivations which we have actually done in our regular lectures, but here for this marathon, this is absolutely sufficient, or you can even take this as a balancing figure and you can close it off. Are you clear with this? That is the story of what? The entire concept of material cost variance. See how simple it is. It is worthwhile the investment of time that you make here. Clear with this? Please do not mug this up. The entire chapter is 100% conceptual and logical. Clear with this, guys? Now, once you understand the logics involved in material cost variance, now labor and variable overhead cost variances are exactly on the same line. Now, let's move on to the next one called as labor cost variance. Now, in labor cost variance, so what is going to be your formula? It's going to be standard hours into standard rate. Now, there in material, we use the word price. In labor, we don't call it as price, we use the word rate. Here, it's going to be what? Standard hours into standard rate minus actual hours into actual rate. This is nothing but what is the labor cost you should have incurred minus what is the labor cost which you have actually incurred. Now, this is broadly classified into three. This is broadly classified into three: labor rate variance on one side, labor efficiency variance on the other side, and labor idle time variance in between. Now, labor rate variance. Now, guys, tell me whose responsibility is labor rate variance? So, who is responsible for fixing the rate? The HR manager. The HR manager. Now, clearly visualize this. Now, what happens here? Now, labor rate variance, right? Standard rate minus actual rate. Every hour, he should have paid how much? 10 rupees. Whereas he has actually paid how much? 11 rupees, right? Multiply it what? Actual hours paid. That is what? For the entire actual hours spent by the workers in the factory, I need to pay them. Are you clear with this? Now, why do I multiply this with actual hours? Because this is not in the control of whom? This is not in the control of the HR manager. So, who decides on how many hours the workers need to spend in the factory? It is the production manager, because he makes them work. Are you clear with this? So similarly, there it was the purchase manager. Here it is whom? The HR manager. Are you clear with this, guys? The standard rate minus actual rate into actual hours paid. Now, on the rightmost extreme side, what do you have here? So here we are gauging the efficiency or inefficiency of the workers. So what will you do? Standard hours minus actual hours worked by them. Actual hours worked by them in the factory, right, into standard rate. Are you clear with this? Why into standard rate? Because my production manager is not dependent on my HR manager. So if I take the actual rate into consideration, then the efficiency or the inefficiencies of the HR manager will get passed on to my production manager, which should not be the case. Clear with this, guys? Now, if you notice, here we use the word actual hours paid. Here we use the word actual hours worked. What do you mean by that? For example, in a week, my workers came to the factory, and in the factory, let us say they spent 100 hours, right? But what happened out of this 100 hours, 10 hours were actually lost due to some power cut, right? So 10 hours were lost due to power cut. So technically speaking, they worked only for how many hours? They worked only for 90 hours. Right? Now, when I'm judging the efficiency, I will only consider what? How many hours you should have taken versus how many hours you have actually worked, actually taken. Correct? I will only take 90 into picture. Whereas when I am paying them, I will pay them fully for the entire 100 hours. Why? Yes, obviously, this 10 hours, they came to the factory, but because of some inefficiency in the maintenance department, right, there was a power cut. Now, you cannot tell them that I will pay you only for 90 hours. You need to eventually pay them for 100 hours. So, for each of the 100 hours, the HR department paid them. Are you clear with this? So then what happens, sir? In between this 10 hours, it is not getting accounted. That's why we have something called as labor idle time variance. Idle time into standard rate, or in other words, idle time is what? It is the difference between your actual hours paid and the actual hours worked. Are you clear with this? Now that also gets tracked up, and this is always an adverse variance, right? It can only be adverse. It is a waste of money. I am paying them. It's a benefit lost. I told you, right? It's a benefit loss. I am paying the money, but I do not get any benefit out of it. Are you clear with this? These are the three variances under labor cost variances. Now, this labor efficiency variance can be further classified into what? Labor mix. Mix is also known as gang. Labor gang or mix variance. Gang means what? Group of people is called as gang. So now when you have more than one skill set, like your what do you call, your unskilled, semi-skilled and skilled workers and all. Now in this case, only when you have more than one skill set, you have this concept of mix or gang variance and all, and the other one is called as yield variance. So now similarly, gang variance, what is the formula? Revised standard hours minus actual hours worked into standard rate. That is the variance that is attributable to the deviation in the mix. So if I am using more of a cheap labor and less of a costly labor, if I'm deviating from the mix, what is the amount of variance that is attributable because I'm deviating from the mix is what gets captured here under the mix or gang variance. Are you clear with this? And on the other side, you have the labor yield variance, which is nothing but the balancing figure. If you see overall, if you add these two, this gets knocked off. RSH is there, minus RSH. These two gets knocked off. You have standard hours minus actual hours worked into standard rate. You get the topmost figure. Clear with this? But there's also another formula, which is actual yield minus standard yield into standard cost per unit. Are you clear with this, guys? Right? Now, all these things, don't worry. We will be doing one full numerical problem, a comprehensive numerical problem. So do not worry. The application of these formulas, we'll be seeing it. You need not have to worry about it. Here, I'm just trying to explain all the formulas, the logic for every formulas. So originally all these logics and numerical problems, which took us 15 hours, more than 15 plus hours in a regular batch, I'm trying to consolidate it and present it in a capsule so that it is easier for you to revisit the entire core concepts of this chapter, in a fraction of about 1.5 hours. Clear with this, guys? Now let's move on to the next one, which is going to be variable overhead cost variances. Now variable overhead cost variances are fairly simple. Similarly, so what should be the variable overhead? Example, your power and fuel cost, right? So what should have been the variable cost incurred? Compare that with what is actually the variable overhead cost incurred. So what is it? Standard hours into standard rate minus actual hours worked into actual rate. Now always remember here for variable overheads, the actual hours are only actual hours worked. Why, sir? Their actual hours paid I will not consider. No, only when you turn on the machine, right? Only for every hour the machine is being running, only for that you'll be incurring variable overhead, right? Whereas that is not the case for labor. In labor, even if it is not working, for the labor workers I need to pay, right? Here we are talking about variable overheads. So actual hours always stands for actual hours worked. There is no concept of idle time and all when it comes to variable overhead. Clear with this, guys? We have even seen a few numerical problems regarding that. Now this is broadly classified into two: variable overhead expenditure variance, variable overhead efficiency variance. Now expenditure variance. Now tell me, guys, whose responsibility is your expenditure variance? Similarly, here the expenditure variance is the responsibility of whom? The maintenance manager. The maintenance manager. So now let us say, see, in our household, right? So what we do, so for every unit of power, we pay some 5 rupees, 6 rupees, 8 rupees, depending on which city or which state you are in. Are you clear with this? Whereas in case of companies, that is a completely different tariff altogether. They are using this for industrial use. In fact, some companies even use private power and all. There, they can negotiate. Now you and I cannot go and negotiate with the electricity board saying, you pay me 5 rupees, I will pay you 5 rupees per unit or 6 rupees per unit of power. No, we can't do that. Whereas companies for industrial use, they can do that. That negotiation is what we are talking about here. So standard price minus actual price. Here, let's say for every unit of power, or for every unit, right, for every hour for which the machine is working, for every hour for which you are using the power, right, they had planned, the company has mentioned that you can spend 10 rupees. Whereas what has happened, our maintenance manager, he had poor negotiation skill, because of which he finalized the deal at 12 rupees for every hour my machine is being running. Are you clear with this? So technically what has happened, they end up paying 2 rupees more for every hour they are using power facility. Are you clear with this? This is what gets captured here. Standard price minus actual price into what? Actual hours worked. Why we take actual hours here? Again, the same reason. The maintenance manager is dependent on the hours. So he's dependent on the production manager for the hour decision. Are you clear with this? He does not get any authority over deciding how many hours need to be spent here. Are you clear with this, guys? On the other hand, you have variable overhead efficiency variance. Efficiency variance is the responsibility of whom? Again, the same guy, the production manager. So here what comes in, guys? Here it's going to be standard hours, the hours that you should have spent, minus actual hours worked, the whole into standard price. Are you clear with this? Why do I use standard price? If I use actual price, then the efficiency or inefficiency of my maintenance manager gets passed on to the production manager in a scenario where the production manager is not at all dependent on the maintenance manager. Are you clear with this, guys? There is a one-way traffic. Now, maintenance manager is dependent on the production manager. That's why I use the actual hours here. Whereas the production manager is not dependent on the maintenance manager. That's why I don't use the actual price here. I only use the standard price. Are you clear with this? Have this crystal clear clarity. Now, where will you go wrong? You tell me. Clear with this, guys? Now, that is all the entire story about variable overhead cost variance. Now, here efficiency variance further classified into mixed yield. That concept itself is not there. Clear with this, guys? Only it stops here. Now, let's go on to the next one, which is fixed overhead cost variances, right? Now, fixed overhead cost variances, it is completely a different animal altogether. Here, we compare what with what? We compare absorbed fixed overheads with actual fixed overheads. Clear with this, guys? So, basically, fixed overhead cost variance represents what? Under absorption or over absorption. Clear with this, guys? Many students think that it is standard fixed cost versus actual fixed cost. First of all, when it comes to fixed cost, there is no concept of standard. You only have budgeted fixed overheads, you have actual fixed overheads, you have absorbed fixed overheads. There is no question of standard fixed overheads and all, because the concept of standard comes only for the components of variable cost and all. Clear with this, guys? For the actual production, what should have been the material cost you should have incurred? What should have been the labor cost you should have incurred? What should have been the variable overhead cost you should have incurred? Whereas fixed costs, irrespective of your volume, it remains the same only, no? Are you clear with this? There is no concept of standard here when it comes to what? Your fixed overheads. Now, so fixed overhead cost variance is basically capturing what? Your under or over absorption. Was the formula? Absorbed fixed overheads minus actual fixed overheads. Now, this gets branched into two: expenditure variance and volume variance. Expenditure variance is what? So now let me just give you an example, right? So you have what? Budgeted fixed overheads, right? So let me just take this up. Budgeted fixed overheads, right? Budgeted fixed overheads. Let's say I budgeted a fixed overhead of 100 rupees, right? But I absorbed a fixed overhead of, let us say 90 rupees. Whereas the actual fixed overheads was how much? Let us say it was 110 rupees. Are you clear with this? Now this particular concept of fixed overhead cost variance compares what with what? It compares absorbed fixed overheads with actual fixed overheads. In this case, it's going to be what? So absorbed fixed overheads 90, actual fixed overheads is how much? 110. So basically here it's going to be 20 adverse. Are you clear with this? Now expenditure variance talks about what? It compares what and what? My budgeted figure with what? With my actual figure. It is 100 minus 110. You have incurred 10 rupees more. Are you clear with this? Budgeted minus actual. Now what is fixed overheads volume variance? It is actually the balancing figure. This is how I asked you to remember. Are you clear with this? Balancing figure. That is what? So the daddy, that is the top figure, compares absorbed with actual. Right, on the left side I am comparing budget with actual. So on the right side the balancing figure should be what? So I should now remove this figure, that is absorbed fixed overheads minus budgeted fixed overheads, or in other words, if you add these two and see, you should get the top figure. Now in this case, budgeted fixed overheads minus budgeted fixed overheads, it gets cancelled. Basically what you will get as a topmost figure, absorbed fixed overheads minus actual fixed overheads, you will be getting this figure. Are you clear with this, guys? Are you clear with this? So this is just for the purpose of understanding that I mentioned you. Clear with this, guys? Are you all able to understand? Yes. So now fixed overheads expenditure variance is what? Budgeted fixed overheads minus actual fixed overheads. Your volume variance is going to be what? Your volume variance is going to be absorbed fixed overheads minus budgeted fixed overheads. Now your volume variance is further classified into two. What and what? Capacity variance and efficiency variance. Capacity variance is what? Actual hours into standard rate. So for the actual hours, if you multiply the standard rate, what is the figure that you will get? Compare that with budgeted fixed overheads, right? Once again, efficiency variance is the balancing figure. That is what? If you add this two, you should get the daddy, the top figure. So now if you see here, this actual, so here the formula is absorbed fixed overheads minus AH into SR. So AH into SR and AH into SR gets cancelled. If you add up these two, you will get absorbed fixed overheads minus budgeted fixed overheads. Are you clear with this? So this should be coined in such a way that if you add this figure with capacity variance, you should get the volume variance. So what will you do that? How will you do it? Very, very simple. So very simple. So here what will you do? You have AH into SR, which you don't have in the topmost figure. So subtract that. That needs to be removed. And now I need to have absorbed fixed overheads that you introduce here. So absorbed fixed overheads minus AH into SR, you get this efficiency variance. Are you clear with this, guys? Now it doesn't stop here. The capacity variance is further classified into two: the revised capacity variance and calendar variance. Very simple. It is just one small tinkering they do. This is nothing but the same thing only here. It's going to be AH into SR minus revised budgeted fixed overheads. Are you clear with this? This generally we have seen this. When do we use this? When the number of days in the budget data and the number of days in the actual data are different. So what we do is we use this concept of calendar variance and all. So immediately what happens? I should get the daddy figure. What will I do? I will remove this revised budgeted fixed overheads minus budgeted fixed overheads. So basically what happens? This gets revised here itself. It gets reversed here itself. If you add up the two, you will get the topmost figure. Are you clear with this? So here it's AH into SR minus budgeted fixed overheads. So your revised capacity variance, what is it going to be? AH into SR minus revised budgeted fixed overheads. Immediately I will say revised budgeted fixed overheads minus budgeted fixed overheads. These two figures get cancelled here. Ultimately, if you add up the two, you will get the top figure. Are you clear with this? This is entirely a subject matter of what? Arriving at the balancing figures. But this top area, you need to know what fixed overhead cost variance stands for. It stands for under or over absorption. So once again, let me just tell you, this is the most difficult area in this entire chapter because it deviates from whatever the other variances talk about. Here the fixed overhead cost variance is what? Your absorbed minus actual. On the left side you have expenditure variance. It's going to be budget minus actual. So your volume variance is going to be your balancing figure. That's absorbed minus budget. Now volume variance segregate into two: capacity and efficiency. Capacity variance AH into SR minus budgeted fixed overheads. Now here what do? I need to arrive at the topmost figure. So once again use the concept of balancing figure. Absorbed fixed overheads minus AH into SR. You get this. Now your fixed overhead capacity variance gets classified into two: revised capacity and your calendar variance. Revised capacity is going to be H into SR minus revised budgeted fixed overheads. Immediately that needs to be reversed. Revised budgeted fixed overheads minus budgeted fixed overheads. Are you clear with this? This is the entire summary of your fixed overhead cost variances. So right, this generally we take a lot of time in doing this fixed overhead cost variance, about 4-5 hours we take. But here, since this being a revision marathon, I have just subsumed it and I'm presenting it in a capsule so that it's easy for you to revise it. Clear with this, guys? Right, now let's move on to the next one. That's about the 4 cost side variances. Now let's move on to the next one, which is called as the sales side variances. The sales variances. Number 1, sales variance can be done under 2 approaches. One is called as a total approach. The other one is called as a margin approach, right? So what is this total approach stands for? Very simple, very simple. So this total approach basically captures what? Your budgeted sales minus actual sales. Are you clear with this? Budgeted sales minus actual sales. What is the sales that you should have made? Basically the sales that you budgeted minus whatever sales that you have actually made. Now again remember, there is no concept of standard sales when it comes to sales. Are you clear? When it comes to sales, there is no concept of standard. Why? See, I am planning to sell so many units. I have actually sold so many units. There can only be budget and actual. Right, you can't have something called as standard and all, unlike the variable cost side variances like your material, labor and variable overhead. Are you clear with this? So yes. Now what is the total side variance? Very simple. Budgeted quantity into budgeted price. That gives you what? The budgeted sales minus what? Actual quantity into actual price. As simple as that. Are you clear with this? This gets classified into 2. Now if I just present the sales side variance, total sales variance is so much. That is not enough. Now immediately your managing director will ask, why has the sales variance happened? Bifurcated into 2. What and what? Sale price variance and sales volume variance. Sale price variance. Who is responsible for sales price variance? Your marketing team, your marketing manager. Are you clear with this? This guy fix your selling price and all that, right? Now every unit I should have sold it for 10 rupees. Now guys, this guy was able to sell at 11 rupees. Now, what has happened in this case? It's a favorable variance. Why? Sir, 10 rupees or 11, this is not cost side variance. Had it been cost, it would have been adverse. Here it's a sales side variance. So every unit I plan to sell it at 10 rupees. But what have I done? I've done a good job. My marketing manager has done a good job. He's able to sell it at 11 rupees. It's a benefit for me. The variance that goes on to increase your profit should be a favorable variance. In this case, it's a favorable variance, right? So budgeted price minus actual price into what? Into actual quantity. Why? Because the quantity decision is not taken by the marketing manager. Then who takes the quantity? The volume decision, who takes it? It is taken by another guy called the sales manager. Are you clear with this? He decides on how many units to sell. This marketing manager decides on what should be the selling price. Clear with this, guys? So the marketing manager is dependent on whom? The sales manager. So the same logic here. So into actual quantity. When I say quantity, it means what? Units sold here. Are you clear with this? Now on the other side, the sales volume variance, what is it? Who is responsible for the volume? Sales manager. So budgeted quantity, you should have sold 10,000 units, right? But you have sold how much? Only 9,000 units. Are you clear with this? Right? Budgeted quantity minus actual quantity. But I can't leave it in units. I need to convert it into rupee. So multiply it with what? budgeted price. Now, why should I not multiply with actual price? Because the sales manager is not dependent on the marketing manager for anything. Are you clear with this? If I take the actual price here, then the efficiency or the inefficiency of the marketing manager will get wrongly passed on to the sales manager. Are you clear with this, guys? Are you clear with this? Hence, it still stands with budgeted price. Every single thing is the same logic, not even a single formula needs to be marked up here. Clear with this, guys? Right now, the volume variance can be further classified into what? Sales mix and sales quantity variance. Now, when will you have these two bifurcations? When the company is dealing in more than one type of product. Are you clear with this? So here, what is the formula? Revised standard quantity minus actual quantity into what? The budgeted price, and this is going to be the balancing figure. The budgeted quantity minus revised standard quantity into what? Into budgeted price. Now, guys, basically, what is this? Now, the company deals in more than one type of product. Now, if I'm selling more of a costlier product, less of a cheaper product, now because of the deviation in the mix, what is the amount that is attributable to my overall sales volume variance is what gets captured here. Now, here the quantity variance, what does it track? Overall, A plus B plus C put together, you should have sold 10,000 units, but you have sold 11,000 units. Because of deviation in the overall quantity, how much is the amount that is attributable to my volume variance gets captured under quantity variance. Are you clear with this, guys? This is what this entire total sales variance under total approach talks about. Basically, remember, the sales variance under total approach captures what? The difference in the budgeted sales revenue, right? Budgeted revenue versus the actual revenue. Whereas, what does this margin approach talk about? What does this margin approach talk about? This margin approach is exactly the same. Wherever you use budgeted price, you use budgeted profit or budgeted margin. Wherever you use actual price, you will use actual margin. Are you clear with this? Here it says what sales margin variance is budgeted quantity into budgeted margin minus actual quantity into actual margin. For example, I was planning to sell 10,000 units, and every time I sell a unit, I know that I will be getting how much? I plan to earn a margin. What do you mean by budgeted margin? Look at this. Budgeted margin is nothing but the budgeted selling price minus the standard cost per unit, or in other words, the budgeted cost per unit. Are you clear with this, guys? Right? So if I sell every unit, what is the profit that I am planning to earn for every unit? Are you clear with this? Right? So I was planning to earn a total profit of how much? 50,000 rupees. Are you clear with this? Whereas, what is this actual quantity? I ended up selling 12,000 units. Very good. But every time I sold a unit, the actual margin that I got was how much? It was only 4 rupees. Are you clear with this? So 12 into 4 is how much? 48,000. So here we are trying to find out how much amount of profit is, what is going to be the profit variance attributable to the sales side. Are you clear? This is not the overall profit variance. We are here capturing what is going to be the difference in profit arising purely on account of the sales side. Here, the cost side variances are not even considered. Are you clear with this? That is what has been done here. So sales variances alone can be done under total and margin approach. Clear with this? And one very important thing here is the calculation of actual margin. How do you calculate actual margin? First, how do you calculate budgeted margin? Budgeted margin is also budgeted selling price minus standard cost per unit. Basically, budgeted cost per unit. Clear with this? Anything you can call it. Actual margin, what you will think? Sir, actual selling price minus actual cost per unit. No, it is actual selling price minus standard cost per unit only. Are you clear with this? It is actual selling price minus standard cost per unit only. Clear with this, guys? The reason for this, we have seen this in depth in our regular batch. But anyways, can we just give you a small glimpse of it? Here, I only take the standard cost per unit because the actual cost side variances are anyways getting captured under my cost side variances. Material plus labor plus variable overhead plus fixed overhead. Clear with this? So here, I am just trying to capture the change in variance attributable to the sales side because of the change in my sales side. Are you clear with this? That is the reason why here the actual margin calculation is actual selling price minus standard cost per unit. And one more thing, guys, which I again told you in the regular batch, this clarity is lacking in our CMA Institute study material. So that's why I asked you to make a specific note of this also, because every sum they have used they have used different ways, but ultimately what they have done is only this. The back end calculation is only this, but every sum they have given different ways of doing it, but ultimately the answer will match with whatever we have learned only. So please follow this. It will make your life very simple. And one more thing, the word budget margin and budget profit, the word margin and profit can be interchangeably used. Budget margin or budget profit are the same. Actual margin, actual profit, these are all same only. So the word margin and profit can be interchangeably used. So now what is your sales margin variance? It's going to be budget quantity to budget margin minus actual quantity to actual margin, classified into two, segregated into two. Sales margin price variance. What is it? Simple. Instead of price, you put margin. Budget margin minus actual margin into actual quantity. On this side, it's going to be sales margin volume variance, budget quantity minus actual quantity into budget margin. Now further classified into mix and quantity variance, revised standard quantity minus actual quantity to budget margin. Here it's going to be budget quantity minus revised standard quantity into budget margin. Clear with this, guys? Basically what happens here, it is the total approach only. Instead of price, you use margin. If it is budget price, here you use budget margin. If it is actual price, here you use actual margin. And that's about this entire formulas and concepts involved in this chapter in a nutshell. Are you clear with this, guys? Right? So with this, we have covered all the concepts, all the major concepts involved in this chapter. Now, one more thing. I think there are one or two questions involved that are involving reconciliation, right? That I am not doing it in our marathon. In our regular lectures, that is also done, but do not worry about it. The main core area of this particular chapter revolves around this calculation of all the variances. So basically, what are the different types of variances that we have got? We have got 4 cost side variances and 1 sales side variances: material cost variance, labor cost variance, variable overhead cost variance, fixed overhead cost variance. And on the sales side, the variances are calculated under 2 approaches. One is under total approach, the other one is under margin approach. Clear with this, guys? Right? Now, what we will do is we will take up one question. We will take up one full question, right? And the comprehensive question, single question, right, that touches upon all calculation of all the cost as well as the sales variances both under total and margin approach. A comprehensive question. It is there in our institute study material only, which we did in our regular batch. If you remember, in our regular batch, I also asked you to mark it as important, a must visit sum the day before exam and all. I gave you guys a library of adjustment. So that sum only we are going to do right now. Fine. So now let's get started. Now let's move on to the comprehensive numerical problem, right? So this is question number 34 that we did in our regular batch. So basically this is our regular course material that I'm using right now. So now let me just read out the question for you. The following information related to a manufacturing concern is given below, right? They have given the word standard weight. So what I've told you before, just because they have given the word standard, please do not get misled, right? What do you mean by standard? For the actual output, what should have been the cost which you should have incurred, correct? Now, sometimes the word standard which is used in the question ideally refers to budget, right? So we should see for what volume level they are given this data. Based on that only you can conclude whether this is actually standard or budget, right? Now, first they have given material A 24,000 kgs, the rate of 3 per kg, 72,000 rupees. Material B 12,000 kgs, the rate of 4, it's 48,000. Wages is 60,000 hours at the rate of 4 per hour, it's going to be 2,40,000. Variable overheads is going to be 60,000 hours. It's going to be how much? The rate of rupee 1 per hour, it's going to be 60,000 rupee. Fine. Then you have fixed overhead, 60,000 hours, the rate of 2, it's going to be 1,20,000. The total cost is 5,40,000. Budget profit is 60,000 rupees. So the budget sales is going to be how much? 6 lakh rupees. And the budgeted units of production is going to be how much? 12,000 units. So basically they have given us the entire budget for pertaining to how many units? 12,000 units. Now look at this. Actual first units sold is 9,000. Wait, immediately what you can conclude? Basically this data, the word they have used, but standard here is actually not standard, it is budget. Why? Had it been a standard data, this would have been for the actual production. For you to produce or for you to actually produce and sell so many 9,000 units, what should have been the cost you should have incurred? That's how it should have been, right? Fine. It is not like that. It is pertaining to a different volume level. So clearly it's a budgeted data. They have given the word standard as a trap. Clear with this, don't fall for it. Next. So sales given 9,000 units. The sale value, actual sales is going given as follows. Material consumed A and B in terms of kgs is given, in value is given. If you divide the two, you will get the kg, the actual price per kg of A and B. Wages paid, they have paid wages for 48,000 hours. The value is given. If you divide the two, you will get the actual rate. The fixed overheads actually incurred is given. Variable overhead actually incurred is given. Labor hours worked. Now be very careful. Labor hours worked is 47,700. Right, the labor hours paid is how much? 48,000. The difference of 300 is nothing but your idle time. Are you clear with this? Abnormal idle time. Basically, this is what gets captured under the idle time variance, which we have seen. Right now, very, very important and a beautiful and a unique adjustment in this particular question is with respect to your closing WIP. Now, they have given that closing WIP is how much? 900 units. Obviously, WIP is what? Incompleted units. They have given the degree of completion. With respect to material A and B, it's 100% complete. With respect to wages and overheads, it's 50% complete. Simple. You're required to calculate all the variances in this particular concern. Now guys, a beautiful question. In fact, if you remember, I asked you to mark this as important. I gave you the library of adjustment, that is basically in our regular batch. I dictate for every single sum that we do, I dictate what the sum was about, right? So there I gave you, this is a comprehensive sum where we had to calculate all the variances, right? Your material variance, labor variance, variable overhead, fixed overheads, sales variance under total and margin approach. And this sum over and above all these things had a unique stock adjustment, that too closing stock, that too with different degree of completion. One of the most top rated question in this entire chapter. This is what I told you in our regular batch also. That is the reason why I picked this up for the purpose of revision. Now, before we get into this particular problem, I want to tell you one very important thing. The solution given, this is a study material question, a very good question. We should appreciate that the institute has taken this question in the study material. But on the flip side, I want to tell you guys that the solution given in the institute study material is wrong. They have made a lot of mistakes and error with respect to this question. So this entire question, I have solved it, which we will be doing right now, right? The solution will also be provided to you. Do not miss this sum. This one single question is a brilliant and a strategic way to revise the entire chapter. Having covered all the concepts, this is a must visit sum. In fact, mark this sum as important the day before your exam, or even if you're just 1 or 2 hours before your start of your exam. Even in that case, I would suggest that if you want to revise standard costing, pick this sum. That is the importance of this sum, because it tells a lot of other things as well apart from whatever we've seen till now. Now guys, let me tell you one very, very important thing in this particular area. Now basically, if you see, we have this, all the variances we've got, right? The variances are classified into what? The cost side variances and sales side variances. Cost side variances further bifurcated into material variance, labor, variable overhead, fixed overhead variances, and the sales side we have total and margin variance. Now always remember this, sales variances, right, are always tied to units sold. Obviously, the sales is pertaining to units sold, whereas cost side variances are tied to units produced. Why? Because whatever cost I incur these costs for the production, not for units sold. Sir, what are you saying, sir? Can you give us an example? Yes, let us say I have produced 10,000 units, right? Now forget this question, I'm just giving you an example. I've produced 10,000 units. Out of these 10,000 units, I have sold 8,000 units, right? And I have unsold, that is, I have produced and I've kept as a stock with respect to 2,000 units. Now you tell me, all the costs that I incur, are they incurred only with respect to the units sold, or are they incurred even with respect to the 2,000 units which I have produced, but I have deliberately kept it as a stock? Yes. So I incur these costs with respect to both the units sold and the units unsold. Or in other words, all the costs are incurred for the production. Whereas with respect to sales, they are exclusively pertaining to sales only. So they are tied to units sold. So always remember, for all our calculation purposes, what we need to do is the cost side variances are tied to the units produced and the sales side variances are tied to units sold. Number one. Number two, in this question, basically, you don't have any opening stock and all. So what is the total number of units produced? Now be very careful here. So basically, what is the total number of units produced? Sir, I was able to sell 9,000 units. So I produced 9,000 units plus some units I have kept in stock, 900 units. Now wait, I cannot add this 9,000 units with this 900 units and say, okay, sir, totally I have produced 9,900 units. No, had it been FG, then I could have added this, but this is a WIP. They have a different degree of completion. These are incomplete units. What they are saying, with respect to raw material, these products, these 900 units are fully completed. However, with respect to labor and overheads, they are only semi-finished. They are only 50% complete. So what we need to do is, using raw material costs, how many equivalent units I have produced, I need to calculate that. Using wage cost, how many equivalent units I have produced. Using wage and overheads, how many equivalent units I have produced, I need to calculate that. So basically, the actual units produced for the purpose of computing my material cost variance will be different, and the actual units produced for the purpose of computing my wages and overheads will be different. Are you clear with this? What is this? Let me just walk you through this. Now look at this. See, in our institute study material, right, up to this they have done correctly, but while for the purpose of calculating variances, left, right and center, there are a lot of mistakes. So that's why I've written the entire question for you. Now look at this, guys. In order to calculate the cost variances, these are the exact words given in the study material which I've kept in our handbook. Right? In order to calculate the cost variances, the statement of equivalent production is prepared first, and to prepare the statement showing standard and actual cost of material, which are shown as below. So basically, statement of equivalent production, what they have done, simple guys, do not worry about it. Now I have consumed raw material A and B. Using raw material A and B, totally how many units got produced? Units completed, 9,000 units definitely got completed. Now I also produced the closing WIP. How many units of closing WIP were there? 900 units, and each of these 900 units have consumed the entire raw material A and B, correct? Or in other words, with respect to material, they were 100% complete. So here 900 into 100%, how much is that going to be? It's going to be 900. So with respect to raw material, I have actually consumed my raw material cost, and I have produced how many equivalent units? 9,900 equivalent units. Are you clear with this? This is the interpretation. Whereas with respect to labor and overheads, by consuming my labor and overhead cost, how many units have been produced? Anyways, this 9,000 units sold, they are fully complete. Only if they are complete, they can be sold, right? So 9,000 units. However, if you look at the question, they have clearly mentioned here that, look, with these 900 units lying in your closing WIP, they are only 50% complete with respect to what? 50% complete with respect to labor and overheads. Or in other words, 900 units, 50% complete is equivalent to 450 units. That is half of it. 450 units fully complete. Correct, guys? Yes. So what we do here is 50% of 900, we'll say 450. So 9,000 plus 450, 9,450. So for the purpose of computing my labor and overhead variances, I will say by consuming my labor cost and overhead cost, 9,450 equivalent units got produced. Are you clear with this? This is one very unique question where you had different equivalent units for different components of cost. Ideally speaking, this is actually a concept which we see in paper 8 cost accounting. There in the chapter called as process costing, we see that they have beautifully merged it and they have put it here under standard costing. Clear with this, guys, right? This is the reason why I rated this sum as the topmost sum in this entire chapter. Clear with this, and I wanted to discuss this in our marathon right now. Fine, guys. So now what we do right now, we need to calculate all the variances, right? So now let us get started. Now first, part 1 is about calculating material cost variance. Now immediately what you need to do, by consuming my material cost, how many equivalent units got produced? 9,900. Sir, how do you know? Just now we calculated and just now we saw, right? So just now we saw what was the equivalent, one second. Yes, just now we saw. So how many equivalent units got produced by consuming the material cost? 9,900. Clear with this, guys. So 9,900 equivalent units got produced. So now what we need to do, we need to calculate the standard quantity of raw material A and B. Now, if you look at the question, what have they given in this question? They have mentioned that, look at this, 24,000 kgs of material A and 12,000 kgs of material B, right? This is there in the budgeted data, right? Should have been consumed to get an effective output of how much? 12,000 units. Are you clear with this, right? So now this is what I have mentioned here separately. Now the budgeted data, it's actually not standard. The budget data is, so you can consume 24,000 kgs of A and 12,000 kgs of B, right? If you consume these two, you will effectively get an output of how much? 12,000 kgs of output of your product, units of output, not 12,000 kgs, 12,000 units of output. Now, what do you mean by standard quantity? To achieve my actual production, how many kgs of raw material A and B should have been used? So what is your actual output? 9,900. So for me to achieve 9,900 units of output, how many kgs of A and B I should have consumed? Very simple. If 24,000 kgs I can consume to get an effective output of 12,000 units, how many kgs of A I should consume to get an effective output of 9,900? So here it's 24,000 divided by 12,000 into 9,900. Clear with this? So 24,000. If 24,000 is for 12,000, how much is it for 9,900? Proportionately, you will get what? 19,800. You should have consumed 19,800 units of A. Similarly, kgs of B, how much is it? 12,000, right? Divided by 12,000 units into 9,900. You get what? 9,900 kgs of B. Are you clear with this? With this, we get the standard quantities of raw material A and B, which is 19,800 kgs of A, 9,900 kgs of B. Clear with this, guys, right? Now, what do we do? Yes, now we can prepare the statement. Standard quantity A and B, we just now got the figures, right? You add up the two, totally how many kgs? Totally how many kgs of A plus B were inputted? 29,700 kgs of A plus B were inputted, right? So this got converted effectively into 9,900 units of output. Are you clear with this? This is the meaning, right? Now, what is the standard price? It's given in the question 3 and 4. These figures were given in the question, right? Let us multiply the two because we anyways will be needing this figure. Standard quantity into standard price. If you multiply this, you get 59,400 and 39,600. If you add up the two, totally 99,000 rupees is the total raw material cost you should have incurred for an actual output of 9,900 units. This is the meaning. Are you clear with this, guys? But what has happened? Actual quantity and actual price, these data, we can arrive at it from here. So now, how much actual kgs of A and B were consumed? 22,275 and 10,890. Clear with this, guys? So 22,275, 10,890. These were the actual quantities of A and B consumed, right? And what was the actual cost of A and B? These figures are also there. 62,370 and 44,649. You can just put these figures here. 62,370 and 44,649. Now divide the total value with the actual quantity. You will get the actual price also. Are you clear with this? Now we have got all the ingredients basically for calculation of the variance. What do you need? You need the standard quantity, standard price, actual quantity, actual price. Now raw material wise, we have all the breakup. Right now, it's just a matter of substituting the figures and arriving at the answer. Now, first, guys, what is the total material cost variance? So standard quantity into standard price minus actual quantity into actual price. Basically, we have already done this. So you were allowed to incur a total cost of how much? 99,000, but you have actually incurred a total cost of how much? 1,07,019 rupees. So what you do here, 99,000 minus 1,07,090, basically you get how much? 8019 as adverse variance. This is your overall material cost variance. You have incurred an extra material cost to the tune of 8,090. Are you clear with this, guys? Now, if I leave it here, is it enough? No, I need to further deep dive and find out the reasons for this. Basically, your price and your usage variance. Now, price variance, basically this has got repeated here. Do not worry. Material price variance. What is the formula? standard price minus actual price into actual quantity. Logic, because we are talking about the purchase manager. The purchase manager is responsible for the price that comes within the bracket. Standard price minus actual price. He is not responsible for the quantity. He is dependent on the production manager for the quantity addition into actual quantity. Now, what you need to do, raw material wise, pick the figure. So, where are the figures? We just got it here. So, for example, for raw material A, so how much is this? So, I'm just erasing all these things, the ticks that I've put. Just a minute. Right? So, now for raw material A, standard price was 3. But you have actually incurred only 2.8. Clearly, there is a saving here into actual quantity, 22,275. Look at this. Just a matter of substituting, guys. 3 minus 2.8 into 22,275. So clearly, you see, every unit he has saved the company 0.2 rupees, right? So clearly, it's a favorable variance. So if you multiply that, you get 4455. Similarly, for product B, it's going to be 4. You should have spent 4 rupees, but you spent 4.10. You've paid more. It's an adverse variance into actual quantity, which is 10,890. Look at this. You get a 1,089 as adverse. So you knock these two off. You get a net effective favorable variance of how much? 3,366 favorable. Clear with this, guys? Just a matter of substituting the figures. See how easy it is. The entire crux lies in putting this table. Once you put that, it's just a matter of substituting the figures. Now let's go on to the next one, the usage variance. Formula for usage variance, standard quantity minus actual quantity into standard price. Who is the responsible guy? You guys know it. Who is he? The production manager. So now standard quantity, you can pick this up from this table. So 19,800, 9,900. So 19,800, 9,900. Actual quantity, you can pick it up from here. 22,275 and 10,890. So 22,275, 10,890 into standard price is going to be 3 and 4 respectively. You can just get these figures. So now, guys, for raw material A, he should have consumed 19,800. He's consumed 22,275. Clearly, it's an adverse variance. You multiply, you get the figure and put it as an adverse variance. Similarly, for raw material B, he could have consumed 9,900. Again, you've consumed what? 10,890. More you've consumed into 4. So here also it's an adverse variance. Add the 2, you get what? 11,385 adverse. Clear with this, guys? Now, what you need to do not proceed further immediately. Wait. So material price plus usage variance should be equal to your daddy. That's your cost variance, right? Let us see here. Here you get 3366 as favorable and 11,385 as adverse. So 3366 minus 11,385. How much is this? 8019 adverse. It is tallying. So immediately you can find out that whatever you have done is correct. Are you clear with this? Now further, usage variance gets classified into mix and yield variance. Mix variance, what is the formula? I told you guys, revised standard quantity minus actual quantity into standard price. But I told you, technically speaking, the word should not be RSQ, revised standard quantity. It should have been revised actual quantity. But in our institute study material, they have used the word revised standard quantity. Let us stick to it. Clear with this, guys, right? So now how would you do this? This is what I said I will explain when we are doing the numerical problem. Now, how will you arrive at this? This RAQ is nothing but revised standard quantity, guys. Clear with this guy, right? Now, what you need to do, actual quantity. How much is the actual quantity? So we have the figures here. The actual quantity is 22,275 and 10,890. Put this. First, you need to fill this column, right? You add up, you get how much? 33,165. Now, just insert this 33,165 here. Clear with this, guys. Now, revised standard quantity means what? The actual quantity in the standard mix, meaning what? Totally, what is the total kgs of raw material I've used? 33,165. Fine. But this you should have consumed in your original mix. What is the original mix here? So the mix should have been 24:12, correct? Because that is there in the budget. Clear with this? 24:12, or in other words, 2:1 should have been the mix using which you should have consumed. Every time you are consuming 3 kgs, 2 kg should come from A and 1 kg should come from B. Are you clear with this? That's how it should have been, right? The standard mix. Clear with this? So now if I do it that way, how much is it? So 33,165 into 2 by 3, that will give you 22,110. 33,165 into 1 by 3, how much is this? That is going to be 11,055. Are you clear with this? Basically, this RSQ is nothing but the actual quantity at the standard mix. Are you clear with this? So now what you do? Now you could have consumed 22,110. You have actually consumed more, 22,275. So clearly it's an adverse variance. You calculate this 22,110 minus 22,275 into 3. You get 495 adverse. Similarly, you could have consumed, what has happened? 11,055, but you've just consumed how much? 10,890. So now clearly this is a favorable variance. So into 4 you do, you get how much? 660. So now overall you get a favorable variance. Now what is the meaning of this? Clearly you see. Now guys, what has happened between A and B, which is a costlier material? Obviously B is a costlier material, correct? Now what I have done, I have actually used what we have done, more of a cheaper material and less of a costlier material. Since I've used more of a cheaper material, less of a costlier material, it ended up in a price saving which resulted in a favorable variance. This is what gets captured under mixed variance. I told you, no, more of a cheap and less of a costlier material. Because of this, what is the amount attributable? That is what is getting tracked here under my material mixed variance. Are you clear with this, guys? Are you clear with this? Next, material yield variance. You can do it as a balancing figure, or I told you one of the formulas is what? Actual yield minus standard yield into standard cost per unit. Now guys, what is the actual yield? Yield is basically output. Actually, using my material cost, 9,900 units has been produced, right? But how many units should have been produced for the kgs of raw material that has been inputted? Weight. How would we calculate that? Now all this calculation is not given in the study material. They have just mentioned the figures here. Now let me clearly tell you how this works. Now basically guys, what has happened here is, look, how do you calculate the standard output? If I input a total of 29,700 kgs of raw material, I should get an output of 9,900, correct? But I have actually inputted how many kgs of raw material? 33,165, A plus B put together. For the actual kgs of raw material, what should have been the yield or output you should have got? This is the calculation that is called as standard yield. How would you do that? How would you do that? Very simple. So 9,900 divided by 29,700 into 33,165. That is what we have done here. 9,900 divided by 29,700 into 33,165. For the actual input, you should have got an output of how much? 11,055. But you have actually got only 9,900, and every unit of output cost me how much? Every unit of output cost me how much? Standard cost per unit. Very simple. You go there and find out here. So every unit of output, how much does it cost? The total cost is how much? 99,000 rupees is the total cost for an output of how much? 9,900. Standard cost per unit. You are allowed to incur 99,000 rupees for an output of 9,900. For every unit, how much you are supposed to incur? 10 rupees. Are you clear with this? 10 rupees you are allowed to incur. So basically what has happened here is my material yield variance is, so you should have got, the actual yield was only 9,900, but I should have got, for whatever I inputted, I should have got 11,055 units, right? So I have got so many units less, my actual yield is less, and every unit cost me 10 rupees. So overall, what is going to be my yield variance? 11,550 adverse. Are you clear with this? Why adverse? Because the actual output that I got was less than the standard output that I should have got, which means what? Clearly there is an adverse variance, and in this case it is to the tune of 11,550. Clear with this, guys? Or I don't want all these things, sir. You can also use the the other formula that we have done, the balancing figure formula, standard quantity minus revised actual quantity into standard price. If you do that way also, you will arrive at the same figure only. Clear with this, guys? Now let's move on to the next one, which is going to be my labor cost variance. Now guys, now immediately, for the purpose of labor cost, for the purpose of labor, what is the actual units, what is the actual output that got produced? 9,450. Clear with this, guys? 9,450. The first thing that you need to mention is 9,450. That is got mentioned. Now labor cost variance, what are the different components that you need? Standard hours you need, standard rate, right? Fine, it's got repeated here, standard rate. Then actual hours paid, actual hours worked, idle time, and you need the actual rate also. If you list out these ingredients, automatically you can find out the labor variances. Now guys, so what is going to be the standard hours? What do you mean by standard hours? For me to get the actual output, how many hours I should have spent? Now look at the question. Look at the question. What have they given? The budgeted data. Go to the budgeted data. You are allowed to take 60,000 hours to get an effective output of how much? 12,000 units. So I can take 60,000 hours, right, to get an output of how much? 12,000 units. But for me to actually get an output of how much? For me to actually get an output of 9,450, how many hours I should have taken? For me to get an actual output of 9450, how many hours I should have taken? This is called as standard hours. Clear with this, guys? This is the calculation. 60,000 hours upon 12,000 units into 9450. So for you to achieve an actual output of 9450 units, you should have taken how much? 47,250 hours. Clear with this, guys? And what is the standard rate? Every hour you are allowed to pay how much? So what is the standard rate? Once again, yes, standard rate is going to be 4 rupees per hour. Clear with this? That is what we have mentioned here, 4 rupees per hour. It's got repeated, 4 rupees per hour. Clear with this? Now, what is the actual hours paid? It's given in the question. So the actual hours paid is how much? 48,000. So I have paid them for 48,000 hours. Look at this. It's given in the question. One second, where is it? So the actual hours, yes, wages paid, actual hours paid is how much? 48,000, but the actual hours worked was only 47,700. Clearly these 300 hours are nothing but your idle time. Are you clear with this, guys? And what is the actual rate at which I am paying? They have given this figure. They have paid a total wage cost of 1,91,250 for how many hours? 48,000 hours. So per hour, what is the rate? We have arrived at it. Clear with this, guys? First, we have computed all the ingredients. It's just a matter of plug and play right now. So now, labor cost variance, what's the formula? Standard hours into standard rate minus actual hours into actual rate. So now, plug the figures. Standard hours, how much is it? 47,250. 47,250 into standard rate, how much is it? 4 rupees, right? Into actual hours. So actual hours means actual hours paid, 48,000, right? Into actual rate, 3.984375. You need to read in the decimals if you do that. So you should have incurred a total labor cost of 1,89,000, but you've actually incurred how much? 1,91,250. Clearly the actual is more than the standard, which means it's an adverse variance to the tune of 2,250. Are you clear with this? So now this gets bifurcated into 3: labor rate variance, efficiency variance, and idle time variance. Rate variance, standard rate minus actual rate into what? Actual hours paid. So what's the standard rate? I should have paid 4 rupees, but every hour I've actually paid how much? 3.98 something. And how many hours for which I've paid? 48,000. If you multiply that, so basically what has happened? You should have paid 4. You have only paid how much? 3.98 something, which means you've clearly saved some cost for the company. That's a favorable variance. The calculation is this. Clear with the 750 favorable. Efficiency variance, you were allowed to take how many hours? 47,250, right? But you have actually worked effectively for how many hours? 47,700 hours. Clear with this, guys? So basically you have taken what? More time now, and every hour you've taken more, it applies a standard rate of 4 rupees. So basically it's an adverse variance to the tune of 1,800 rupees. And in between you have this idle time variance. What is the idle time? 300 hours. 300 into 4, it's going to be 1,200, and it's always an adverse variance. So now what you do, add up these three and see if you're getting the topmost daddy figure. So now it's going to be how much? 750 minus 1,200 minus 1,800, how much is it? Minus 2,250. It's going to be 2,250 adverse. Clear with this, guys? That is all about it. It is just a matter of arriving at the ingredients. Once you get the ingredients, it is just a plug and play model. Clear with this, guys? Yes, that's about the sum. Fine, that's about this particular part of the question. Next one, variable overhead cost variances. Now for the purpose of variable overhead, once again, we know that the actual output by consuming the variable overhead, how many units were produced? 9450. Clear with this, guys? So what do you need? You need standard hours, standard rate, actual hours, and actual rate. Clear with this, guys? So now what is the standard hours? Similar calculation. They had given you were allowed to take 60,000 hours to produce 12,000 units. How many hours you were allowed to take for achieving the actual output of 9450? So 60,000 divided by 12,000 into 9450, you get 47,250 is the standard hours that you are allowed to take. Clear with this, guys? And standard rate per unit, how much is this? With respect to variable overheads, it's yes, it's given in the question as 1 rupee per hour. Clear with this? So every hour you spend, every hour is actually the machines are running, you're allowed to incur a cost of 1 rupee per hour. Clear with this, guys? But what is the actual hours worked? We just calculated what is the actual hours worked, which is 47,700. Again, this is given in the question, right? And what is the actual rate? Once again, you can easily calculate. How can you calculate that? It's given in the question. The actual variable overhead is how much? 45,000 rupees is incurred, right? So the actual rate per hour is what? 45,000 rupees I've incurred for actually working 47,700 hours. So per hour, what is the actual rate? It's 0.9433. So now what you need to do, just Just apply the formulas here. Variable over cost variance, standard hours into standard rate minus actual hours into actual rate. Just plug the figures respectively. You'll get, you should have incurred 47,250. You have actually incurred only 45,2250 as a favorable variance. Clear with this, guys? All right. Now this gets bifurcated into two: expenditure and efficiency variance. Expenditure variance, standard rate minus actual rate into actual hours worked. So you should have incurred 1 rupee for every hour. You've incurred only 0.94 something. So basically it's a favorable variance. You can do the calculation, you'll get the favorable variance. Similarly, on the efficiency part, standard hours, you were allowed to take 47,250 hours, but you've taken 47,700 hours. You've taken more hours. Clearly it's an adverse variance. The calculation is as follows. Now once again, you need to check, you add these two. So 2,700 minus 450, you get effectively how much? 2250 favorable. You get the daddy figure, which means that you've done this calculation right. Clear with this, guys? As simple as that. Very, very simple, but you need to get the approach and the logic right. Then we move on to the next one, which is fixed overhead variances. Now, fixed overhead cost variances. What is the actual output? Again, it's going to be 9,450 units. Now, first, let us list out the ingredients. What are the ingredients we need for a fixed overhead variances? Fixed overhead cost variance, you need the absorbed fixed overheads. Absorbed fixed overheads, how will you get it? See, the predetermined rate, standard rate per unit into actual output, correct? So I need all these figures, standard rate per unit, the actual output, then I need the actual fixed overheads. Why the actual fixed overheads comes here? Then I need the budgeted fixed overheads that comes here. Then I need the actual hours and I need the standard rate per unit. All these things we need. If you are able to find out each and every component, then it is just a matter of plugging the figures and arriving at the solution. Now first, what is the predetermined rate? That is standard rate per unit. Very simple. Now go to the budgeted data. They have given what is the fixed overheads. They plan to incur 1,20,000 rupees and they plan to produce how many units? 12,000 units, which means what is the predetermined rate, the absorption rate or the standard rate per unit? It's going to be 1,20,000 divided by 12,000. It's going to be 10 rupees per unit. So 1,20,000 divided by 12,000, it's going to be 10 rupees per unit. What is the actual output? We just calculated. It's going to be 9,450. Clear with this? Then actual fixed overheads given readily in the question, 1,20,900. What is the budgeted fixed overheads? That is also given in the question, 1,20,000. What is the actual hours worked? Once again given in the question, 47,700. Right? What is the actual hours? I mean, it's got repeated here. So basically, I'm striking this off. Actual hours worked, 47,700, and the standard rate per hour. That is also given in the question. Look at this. What is the standard rate per hour? In the budgeted data, they have given the standard rate per hour is how much? 2 rupees per hour. That is also given. Now, guys, don't think it's complicated, right? Most of the data are given here. You just need to know which data to use where. That's all you need to know. Now, what we need to do? Now, just write on the formulas, plug the figures, and you're sorted. That's about it. It's as simple as that. Clear with this, guys? So now let's go here and do this. So now, guys, what is this? So your absorbed overheads, so standard rate per unit into actual output, 10 rupees per unit into 9,450. So I'm absorbing overheads of how much? 94,500, but actual overheads is how much? 1,20,900, which means there is an under absorption, which is actually an adverse variance, gets tagged under adverse variance. How much is that? 26,400. This gets bifurcated into two: expenditure and volume variance. Expenditure variance, budget minus actuals. Well, how much is the budget? Go down, you get each and every figure. Budget overheads 1,20,000. Actual overheads, how much is that? So the actual overheads is going to be 1,20,900. All the figures are given. So I plan to spend 1,20,000, but I've actually ended up spending 1,20,900. So you've spent 900 more. Adverse variance, that's about it. Volume variance is what? Absorbed minus budget, 94,500 minus 1,20,000. You get how much? You get 25,500 adverse. Are you clear with this? Now this gets further bifurcated into two: fixed overheads capacity and fixed overhead efficiency variance. So here it's going to be actual hours into standard rate per hour. The figures are all given. We just calculated the ingredients, plug the figures. 47,700 into 2. Absorbed overhead is 1,20,000. So here the actual hours into standard rate per hour is going to be 95,400, right? Whereas you've spent how much? 1,20,000. So clearly it's an adverse variance, the tune of 24,600. And here absorbed overheads is going to be 94,500, and AH into SR per actual hours into standard rate per hour is going to be how much? 95,400. You subtract the two, you get 900 variance. So now adverse variance. So now you add the two, 24,600 plus 900, you get how much? 25,500 adverse variance. Now you add these two, 900 plus 25,500, you get how much? 26,400 variance. That's all. The entire tree is sorted, and with this we completed the fixed overhead variances. Guys, it is that simple. Now the only what you need to do is first understand the logic, write down the formulas. Number two, from the formulas, what you need to do, list out what are all the ingredients required. Number three, certain ingredients need to be computed while most of the ingredients are readily given in the question. You list it out. Now plug the figures in the respective areas. You will get the answer. Now tell me guys, how is standard costing difficult? How is standard costing difficult? It is as simple as that, and it's very, very logical. Clear with this, guys? And that's about this particular segment of fixed overhead variances. Now let's move on to the next part, which is sales variances. Now guys, sales variance is fairly simple. So how many units were sold here? So 9,000 units. So first let's do it under the total approach. Now what are the four figures you need? Budgeted quantity, budgeted price, actual quantity, actual price. Now we know all these figures. Budgeted quantity, how many units I plan to sell? It's given in the question, 12,000 units. It's given, they gave it under the standard data. I told you it's actually the budgeted data. Yes. What was the budgeted price? Now look at this. In the budgeted data, so what was the budgeted sales? 6 lakh rupees, right? 6 lakh rupees is the budgeted sales for how many units? It is the budgeted sales for 12,000 units. So 6 lakhs divided by 12,000 units. What is the selling price per unit? The budgeted selling price per unit, that's going to be 50 rupees. 6 lakh upon 12,000, it's going to be 50 rupees. Actual quantity, how many units were actually sold? 9,000 units. And what is the actual price? So now it's not directly given, but the actual sales figure is given. 4,57,500. Actual units is also given as 9,000. Divide the two, you get the actual selling price. So how much is that? That's going to be 4,57,500 divided by 9,000 units. It's going to be how much? So 457,500. 457,500 divided by 9,000 units, it's going to be 50.8333. Are you clear with this, guys? Fine. Now you have the figures, just substituted. Now sales total variance, budgeted quantity to budgeted price, 12,000 into 50. I was expecting to generate a sales turnover of how much? Turnover of 6 lakh, but I actually ended up getting a turnover of only 4,57,500. Basically, my sales has dropped by how much? 1,42,500 rupees adverse. Now, what is the root cause for this? Bifurcated into two, the price and volume variance. Now, budgeted price minus actual price into actual quantity. I plan to sell every unit at 50 rupees, but I ended up selling at how much? 50.83. So I was able to sell it at slightly more. And how many units did I actually sell? 9,000 units. Each of these 9,000 units, I sold it at 0.83 rupees, 833 rupees more. So basically, this has given me a favorable variance. How favorable? Because every unit, instead of selling it at 50 rupees, I've sold it slightly at more, which means every time I sold a unit, I slightly got more than what I expected, looking at it from a price angle. So now basically my marketing manager has done a good job. He has contributed 7,500 rupees more to my profit. Clear with this, guys? Whereas what has happened, the issue happened only on the volume side. The budgeted quantity, I planned to sell 12,000, but I was able to sell only 9,000 units. I sold 3,000 units less, and every unit I planned to sell it at how much? 50 rupees selling price. So basically, because of drop in volume, I sold how many units less? The entire value of sales that got dropped because of my volume was how much? Was 1,50,000 adverse. As simple as that. Clear with this, guys? That is all it is. Now looking at it from a margin approach, now what I need to do, instead of price, I need to use margin. Now how will I calculate the budgeted margin? It's the budgeted selling price minus standard cost per unit. Now sir, what is standard cost per unit? Very simple. Look at this. In my budgeted data, what was the total cost that I planned? I was allowed to incur 5,40,000 rupees of total cost to produce how many units? 12,000 units. So 5,40,000 divided by 12,000. How much is it? Per unit, what is the cost that you are allowed to incur? 45 rupees. So 5,40,000 divided by 12,000 units, it's 45 rupees. So per unit, what is the budgeted margin? 50 minus 45, 5 rupees. Every time I sell a unit, I am planning to earn how much? 5 rupees. But what was the actual margin? Remember, this is where I told things become different. I told you here in this case, the calculation is what? Actual price minus standard cost per unit. Actual price is how much? My actual price is 50.83333. Right, but the standard cost per unit is 45, so the actual margin ended up to be how much? 5.83333. Clear with this, guys? So now what is the budgeted quantity? It's 12,000 units. Actual quantity is 9,000 units. So now what you need to do, you need to substitute the figures here and arrive at the answer. So sales margin variance totally, how much is that? So I plan to sell 12,000 units, and each and every unit that I sell, I plan to earn a margin of 5 rupees, but I actually ended up selling only 9,000 units, and every unit I sold actually fetched me a margin of only 5.833. So the profit that I planned for is 60,000, but the profit that I actually got was only 52,500. So this 7,500 rupees is called as the sales margin variance. So basically, because of the sales side, right, because of the issues on the sales side, I have my profit has actually dropped by 7,500 adverse. Now this can be classified into two: sales margin price variance and sales margin volume variance. Price variance is what? Budgeted margin minus actual margin into actual quantity. That gives you, so every time I sell a unit, I plan to earn 5 rupees, but I actually earn 5.833. So every time I sold a unit, I got how much? 8.33 more. It's clearly a favorable variance into what? 9,000 units. It's going to be 7,500. And similarly, the sales margin volume variance is going to be, I plan to sell how much? 12,000 units, but I actually ended up selling only 9,000 units. I sold 3,000 units less, and had I sold each of these units, I would have got 5 rupees of profit. So 3,000 into 5, 15,000 rupees. I lost my profit, so 15,000 adverse. If you knock off these two, 7,500 favorable plus 15,000 adverse, you get what? The daddy comes out to be 7,500 adverse. Clear with this, guys? That is about this particular question. A very, very comprehensive question, but clearly understand, guys, two things that you need to know. Number one, your sales variances are tied to what? They are tied to your units sold, whereas your cost variances are tied to what? Your cost variances are tied to units produced, number one. And number two, when you have a closing WIP with different degree of completion and all, now what you need to do is you need to arrive the component wise equivalent units for material. By consuming the material cost, how many units were produced? By consuming the labor cost and overhead cost, in this case, it was same for labor and overheads, how many equivalent units were produced? That you need to know. And this is, I would call it as the topmost rated sum in this entire chapter. Are you clear with this, guy? And one more thing I wanted to tell you, if you note, the price variance will be the same if whether you calculate it under the total approach or under the margin approach. Under total approach, what is the sale price variance? 7,500. Here under the margin approach, how much was it? It is 7,500. Clear with this, guys? So the price variance alone will be the same whether it's computed under the total approach or under the margin approach. Clear with this, guys? Right? So that is about this entire chapter of standard costing. Right now of course, this is not a substitute for a regular batch, because in our regular batch we've learned this entire chapter for over 15 plus hours. We've done 50 plus numerical problems, every single adjustment. Here, as the name suggests, we've tried to recapitulate all the major areas, all the variances we have tried to cover, and we have done one flagship numerical problem that is the topmost rated numerical problem. And guys, by the way, the solution for this numerical problem is not correct in the institute study material. Please follow whatever I have just told you, because that is the correct solution. I have proved it in front of you, because in standard costing, even if one small mistake is done, it will not tally. Right? We kept on tallying every single figure, right? We branched it out and we tallied. So clearly this is the right answer. You need not have to worry about it. If this question comes in exam, you can definitely do it in a way in which I have told you right now. Clear with this, guys? So with this, we have completed this beautiful chapter called as standard costing. So now let's get started with the revision of the next chapter, which is cost accounting standards. Now guys, this chapter from an examination perspective carries a weightage of 10% every attempt, right? However, this is a theory chapter. That's how I would classify it. Basically, by theory, I mean it is not I could call it as a non-numerical chapter. So it's not a numerical chapter, right? So what is this cost accounting standards, right? So let me just quickly walk you through this. Let's quickly revise this particular chapter. Now guys, there are certain companies as prescribed in the Companies Act 2013. there are certain companies which needs to maintain their costing records. Are you clear with this? They need to maintain costing records, and this is covered under the provisions of Companies Act 2013, right? Sir, which provision of Companies Act 2013 talks about this? Basically a section 148 that talks about the cost audit. Cost audit should be conducted by a qualified CMA, cost and management accountant, right? So who has finished all his exams and who has got his membership from the CMA Institute, right? And of course, he's got his practicing license as well. So a certificate of practice as well from the CMA Institute, right? What does he audit? He audits the cost records. Are you clear with this? So this provision of Companies Act 148 read with Companies Costing Records and Audit Rules, Cost Records and Audit Rules 2014 and Cost Records and Audit Amendment Rules 2014. These are the documents prescribed in the Companies Act that mandates certain companies to prepare and maintain something called as costing records. That's the reason why we are studying this entire subject. Are you clear with this, guys? Now what they have mentioned is companies, how should they maintain costing records? Costing records should be prepared as per the cost accounting standards prescribed by the CMA Institute. So what CMA Institute has done, the Institute of Cost and Management Accountants of India, they have actually set one full board called as your Cost Accounting Standards Board, right? Which has prescribed 24 cost accounting standards to date. So what is a cost accounting standard? Basically, cost accounting standards are nothing but set of rules and procedures based on which you need to prepare your costing records. Very simple. For example, now the concept of absorption, right? The concept of absorption. So now what you need to do, use your predetermined rate, multiply it with the actual base quantity, arrive at the overall absorbed overheads, compare that with the actual overheads, and then at the end of the period, you need to arrive at something called as under or over absorption. We studied all that? No, you are doing it because who told you? That was mentioned in one specific cost accounting standard that dealt with your manner of treatment of overheads. Are you clear with this? So whatever we have learned in this entire subject is squarely covered under the respective cost accounting standard. For example, I told you just few minutes back, right? Your direct expense is getting covered under a specific cost accounting standard number 10. Are you clear with this? So these are nothing but a set of documents prescribed by the CMA Institute that has been compiled by a specific board called as Cost Accounting Standard Board of the CMA Institute, right? Which tells you the do's and don'ts of every specific items that are being covered in our subject. Are you clear with this, guys? Right now, as on date, there are 24 cost accounting standards. Now, sir, so we should know all these cost accounting standards. Basically, the working knowledge of these cost accounting standards is what the entire subject is all about, which anyways gets tested, right? Now, in your syllabus, there is a separate chapter called as Cost Accounting Standards, wherein Institute wants to test you on a few things. Look at this. They have just given a chapter called as Cost Accounting Standards with a huge background and all that, right? Which I just told you. Now, what they are saying is they have given an overview, not the entire cost accounting standards, an overview of cost accounting standards. Now, what you need to know is only this much from an examination perspective. 24 cost accounting standards are there. You should know the cost accounting standard number and the title. For example, CAS 3 stands for what? Production and operation overheads. So you need to know the number of the cost accounting standard, and that number of the cost accounting standard stands for which particular area. That is the title of that CAS you need to know, right? Apart from that, look at this. This is all they have given. Every cost accounting standard, you need to know the objective, scope, right? And certain specific things that could be there. That's about it. This is all you need to know about inside every single cost accounting standard. See, one CAS 1 is over. CAS 2, objective, scope, or something specific to that particular standard is given, which we have already learnt during the course of the entire subject. That's about it. 3, scope, objectives, disclosures. So this is purely a presentation and a theoretical area. Now, sir, I need to know all these things. How will I do this? Very, very simple. Now, let me just tell you first. First, let me walk you through the 24 cost accounting standards. What are all the cost accounting standards there, and what each of these cost accounting standards talk about? First, CAS number 1 talks about classification of cost. So we have seen all this cost classification, right? Now material, labor, overheads, your prime cost, that is your direct cost, indirect cost, all these things, administration overheads, your administration cost, your factory cost, that is your manufacturing cost, your selling cost, manufacturing, non-manufacturing cost, all these cost classifications which we have seen is actually stemming out of a standard called as CAS number 1. CAS number 2 talks about what? Capacity determination. So what should be the normal capacity, what should be the theoretical capacity, what should be the maximum capacity, and all these things. Basically we take normal capacity for the purpose of arriving at what? Our absorption rate and all, right? That's what the standard talks about, right? So more details about this, no, it's not like detailedly mentioned in our CAS also. Just that first what you need to know, the number, the title, then I will tell you an easy trick to write the scope objectives of every single cost accounting standard. You just write it. What 10% is the weightage? They are asking for 8 marks and all. I've seen it. So every attempt they test is very simple to score, very easy to score. Clear with this. Next, CAS number 3, production overhead. So whatever we learned in that overhead chapter, it is actually coming from this particular standard only. CAS number 3. CAS number 4, cost of production for captive consumption. So what do you mean by captive consumption? Let me just give you a quick example. Let's say I'm in the business of manufacturing cars, right? Now, what I do, what is my business? I manufacture cars. Now every car needs tires, no? What happened? I also opened one small factory adjacent to my factory where I manufacture my cars. I opened a small factory. This factory, what I do is I manufacture tires. Now, sir, so you are also in the business of selling tires? No, I manufacture tires for the purpose of my car. I will not sell these tires to outsiders. I will manufacture the tire which is used for my final product. So this tire manufacturing is called as captive consumption. Captive consumption means what? I manufacture something and consume it for my own purpose. Are you clear with this? Now, the cost of production with respect to the particular product which is used for captive consumption, how do you deal with that? That is what is getting covered under this particular chapter. Again, they are not entered into the details. They have just mentioned what are the scope, objectives, and all these things they have just mentioned. That's about it. Clear with this. Nothing great here, but you should know what you mean by captive consumption. That's what I'm saying. Next, average cost of transportation. Basically what this chapter says is transportation related cost. How will you handle? Very simple. Broadly, you incur two transportation costs. One is with respect to bringing the raw material to your location, and number 2 is the transportation cost incurred for selling, that is for the purpose of transporting your finished product to your customer place. Very simple. The raw material related transportation cost should be added to your direct material cost, whereas your transportation cost that you incur to sell your FG should be considered as a part of your selling and distribution overheads. As simple as that. That's about it. This is what the standard says, right? Logically, this is what it says. How do I present it? Suppose if they are asking for scope and objectives of cost accounting standards 5, how do I write it in exam? I will tell you, do not wait. First, I'm just walking you through the list of standards that are applicable. Next, CAS number 6, material costs. So all the material cost related areas whichever we have read is being covered under this chapter. CAS number 7, employee costs. CAS number 8, utilities, cost of utilities. So what do you mean by utilities? Utilities are certain items which are used for the purpose of my production. However, these items cannot be seen in my final product. Sir, example. Let's say I'm in the business of manufacturing pens, right? Now, for me to manufacture the pen, I would have consumed power. So, power is a utility, right? Power cost is a utility. However, this power, can I see it in my final output? I cannot see it in my final output. But without this power, my machines will not run. Without machines running, I cannot produce my pen. So, there are certain costs, certain items which are incurred without which the production cannot happen. However, these items are not physically present in my final output. This is called as utilities. Are you clear with this? Right? In our example, the power that I told you was an example of utility. How do you deal it? Everything we have seen in cost sheet chapter. How do you deal it? Power, right? Power costs. Yes, so generally power cost is treated as POH. Some people even treat it as direct expense. They say the justification they say is, so every time I produce a product, so the number of machine running activity will be more and proportionately my power bill will also be high, but generally we classify it under POH. Now, are you clear with this? This is what I'm saying. Clear with this, guys. Next, packing material cost. Clear with this. So how do you deal with this? If it is a primary packing, treat it as a part of your cost of production. If it is a secondary packing, it comes under your selling and distribution cost. Then your direct expenses, cost accounting standard 10 we've seen. Admin overheads, any cost incurred in your corporate office. Repairs and maintenance costs, specifically they have just given it what forms part of repairs and maintenance. Anyways, so predominantly this comes under your POH only. Cost of service cost center, basically we have seen this in overheads chapter. So in your overheads chapter we've seen that there could be production department, service department. The service department cost should be apportioned to the redistributed to the production department cost based on the services rendered ratio and all, and based on the traffic involved, one-way traffic, two-way traffic, no traffic. Based on that you should use the service, you should use the methods like direct redistribution method, step ladder method, and reciprocal services method. All of that, ideally, where are all these things covered? It is covered here. Are you clear with this? So here they are not going to ask you about treatment of all these things. They are just going to ask you scope, objectives and all. It's very simple, right? As they are purely focusing on theoretical aspect, while the practical aspect is already being covered. Are you clear with this, guys? Pollution control cost. What is it? Every factory, if you're running a factory, you definitely need, you're going to pollute. Obviously, you're going to use all this, when you're converting RM into FG, you'll be using a lot of fuel, and that in turn will pollute the environment. You can't just give away the pollution just like that. You need to install a pollution control equipment, right? And only it will treat all the harmful gases, and only the balance, the harmful gases will be treated, and only the balance that can be let out in the atmosphere will be let out. Are you clear with this? So it is something that needs to be mandatorily maintained by all the factories. So how do you deal with it? Predominantly all this pollution equipment, depreciation on that and all will be treated only as your production overheads, indirect manufacturing costs only. Then selling and distribution overheads, that's CAS number 15. Your depreciation and amortization, CAS 16. So depreciation amortization, what cost is it? You can't directly say, right? If it is a depreciation on your factory building, POH. Depreciation on office building, AOH. Depreciation on your sales depot, SOH. As simple as that. Interest and finance charges. How do you treat with this? It's a non-operating expense, so it is not coming under the ambit of our subject itself, right? It's a non-operating expense, so it comes only under your financial management, or even in your accounts you can say. It does not come, you shouldn't consider it for the purpose of arriving at operating profit. Then research and development costs. Research and development costs are predominantly, so when I do a research, why do I do it? To improve my production facility, to come up with a product related innovation. It's again production related, right? So now generally your R&D costs are considered as a part of POH. Now if you are, in CA Institute, in CA Intermediate, what they do is they actually remove it from POH and they actually mention it on the face of cost sheet itself. That is another way of doing it. Clear with this? But all these things are not there here. It's purely theoretical nature. Scope and objective of CAS 18, if they ask, you should say CAS 18 talks about research and development cost. Now, how do you write the scope, objective, and now I will just walk you through. You need not have to worry about it. Next, CAS number 19, joint cost. Right? Joint cost, we've seen, it's basically your joint and byproducts, a common cost incurred up to the split off point. So that's called as a joint cost. The manner of apportionment, there are several methods, physical units method, there's so many methods. These are all prescribed under the CAS number 19. Then CAS number 20, royalty technical know-how. I just gave you an example of two examples I gave. One is your Maruti Suzuki, yes, and the other one is your Rorito Reynolds, right? So it comes under direct expenses. Then quality control costs. Quality control costs are basically every time I produce a product, right, inspection needs to be carried out. I need to make sure that the quality is actually maintained in every unit that I sell, that I produce. So these are also your production related costs only, but they are indirect in nature. Hence, it should squarely come within the ambit of production overheads. Clear with this, guys? Overall manufacturing cost. So how does it come under overall manufacturing cost? Basically, all the classifications that we have seen, material, labor, expense. Under that, each and every category we subcategorizes under direct, indirect and all the direct components, prime costs, all the indirect components comes under your production overheads. All these categorization is coming under this particular thing. Now CAS number 23 talks about overburden removal cost. Now what do you mean by overburden removal cost? This is very specific to mining sector. If you look at this in mining sector, so what do they do? Let's say a company is in the business of mining gold ores, right? Gold. They are in the business of mining gold. Now how will they mine it? There will be soil, right? Under that soil, they need to excavate and they need to arrive at the, they need to come up with the gold ores. Now, obviously, it will not be gold as such, right? This, they will take it. This is the raw material that needs to be further processed and it gets converted into gold. This process is not easy. That's the reason. And all these gold ores are very slightly scarce in nature. That's the reason why gold rates are very high. Now, what is this? First, there will be soil. Under this soil, maybe it could be so deep. I need to excavate till here. I need to remove all the soil and I need to extract that gold ore here, correct? Now, whatever is this on the top, the soil, it is there full of dust and all that, that is called as overburden, right? For me to extract this gold ore, I need to remove the overburden, correct? that is called as overburden removal cost. This is very specific to mining sector. Now, how do you deal with it? Just to put it short, this is a production activity only, right? This overburden removal cost, if you are talking about a mining sector, in that case, this should come under the category of production overheads. It's an indirect manufacturing cost, right? The manufacturing, it's one of the manufacturing activity, excavating and extracting this particular ore. This is a manufacturing activity, and any cost relating to that should come under your production activity only, but this is an indirect in nature. Hence, we will be putting it under your production overheads. But you should know what it stands for. Clear with this, guys. And CA's number 24 talks about treatment of revenue in cost statements. So how do you treat the revenue and all of that? Clear with this, guys. This is all the set of 24 cost accounting standards. Now, sir, suppose in the exam they're asking us to write down the scope and objectives of CAS number 10. Let us say direct expense. How do we write it? Don't worry. First, they will give only CAS 10. Number one, you should know what CAS 10 stands for. What is it? Direct expense. Next, scope objectives. How will you write it? Very, very simple. See, this is something that you will find commonly for all the standards. First one is meaning, right? What you need to write, this standards deals with the principles and methods of, just write the title name. In this case, direct expenses. Are you clear with this? So what I'm coming up with a common template. Do not mug up everything. So what you need to do, first know all the cost accounting standard number with the title, right? Then you come here, first write the meaning. So CAS 10, direct expenses, meaning this standard deals with the principles and methods of what? Write the name or the title again. That is going to be your direct expense. Next, objectives. Simple, again everything is same. The objective of this standard is to bring uniformity and consistency in the principle and methods of, write the name of the standard, direct expenses, right? With reasonable accuracy. Suppose we are talking about production overheads, write production overheads. If they are talking about direct material, instead of here you just write the direct expense. I mean your direct material. As simple as that. Whatever is the name of the standard, you write it here. Everything else is going to be the same. Simple, isn't it? Easily you can score some 6 to 8 marks. Directly they are going to ask you, provided you know the standard number, you know along with the title. That's all you need to know. And this template you remember. Meaning, objective, and scope. What is scope? This standard shall be applied to cost statements which require classification, measurement, assignment, presentation, and disclosure of, once again write the title, direct expenses, including those requiring attestation. That's about it. That's about this. This entire chapter is over. Clear with this, guys. Clear with this, guys. So first, what you need to know. So first, there are 24 cost accounting standards prescribed by CMA Institute, right? They have set up a separate committee or a board called as the Cost Accounting Standard Board, right? And first, you need to know what are the 24 cost accounting standards. These are the 24 cost accounting standards. I've just briefly told you what each and every standard deals in. Clear? Why have I told you this? Only then you need not mug it up. You will at least know what each of these standards are talking about. The practical implementation of this, we have studied it during the course of our subject. This chapter is only a theoretical chapter. Now, what they will ask, right? They will ask you to write the scope and objective of CAS number 10. So, CAS 10, direct expense. Now, what do you need to do? Come here and write down first meaning. This standard deals with the principles and methods of, write the title, direct expense. Objective. The objective of this standard is to bring uniformity and consistency in the principles and methods of direct expense with reasonable accuracy. Then scope. This standard shall be applied to cost statements which require classification, measurement, assignment, presentation, and disclosure of, write the title, direct expense, including those requiring attestation. As simple as that. Clear with this, guys. Now, apart from this, there could be certain definitions. For example, there could be something like, what do you mean by prime cost? Right? In cost classification, that could be, what do you mean by prime cost? What do you mean by direct expense? What do you mean by direct material? If they are asking all that, whatever you know, logically you write it and leave it there. Do not mug it up. Logically you write and leave it there. That's about it. Some definitions specific in certain standards, whatever you know, logically you write. Do not mug it up. This is about the entire chapter. Do not waste time. Right? Play it smart. You should know how to play it smart. And this is all about this chapter. 10% weightage is no joke, guys. No joke. So as simple as that. So first, know the titles. Know the standard cost accounting standard numbers with the titles, and then know this template and just plug it in. And that's about it. Some 8 to 10 marks guaranteed in your exam, right? Theory, pure theory. It has nothing to do with practical implementation of the subject. All the practicalities are already covered, which in the respective chapters, we've done numerical problems. As simple as that. Clear with this, guys. So with this, we have completed this particular chapter, and with this we are coming to the conclusion of this marathon of paper 8 cost accounting, right? So guys, all the very best for your exams. One very important message I want to share with you all: please have the confidence in whatever work that you're doing. You guys are so dedicated. You've spent a lot of time, you have invested your time productively, and if not for you, who will pass? Right? Have this confidence in your mind, because in my opinion, in professional courses like CA and CMA, most of the students fail even before they enter into the exam hall, right? The biggest problem is that lack of self-confidence. They don't have the confidence. Without this, they enter into the exam hall. They tend to forget even those areas which they have completely prepared for. Are you clear with this? Please don't fall into that trap. You guys have given your best. You are still giving your best, and you will continue to give your best. As simple as that. Have the confidence, and half of the entire the burden is already removed, right? And you're already halfway through. The moment you have the self-confidence, you are already halfway. You're close, inching close to your success, and that's about it. Are you clear with this, guys? Right? On that note, I'm signing off in this particular marathon series. I will meet you all in CA final. Thank you all so much. Bye bye.